Do you think the president has any power whatsoever, any executive power, to do something about the mess that is the southern border?
Yes. I mean, I think, John, that one of the problems over the last few months has been the White House hasn't had a plan, but there is an opportunity where they could just unilaterally shut down the border. I mean, Biden could do something dramatic, but on this issue, at least, it hasn't been, we haven't seen it.
But the president is saying that he needs congressional approval to do that. And if that were true, then why didn't Trump do that when he said he would when he came into office?
Again, I think Trump wanted to keep the issue alive. I mean, as long as he keeps this issue alive, it usually works to Trump's favor.
But, Greg, wouldn't this be just a slew of, this would be held up in courts? Wouldn't there be a number of legal issues if the President of the United States came out and absolutely shut down the border?
Yes, and I think that it would hurt commerce. There's a lot of unintended consequences if he did that. So I think Biden is stuck. We're at a point now where there's not enough time to get a sweeping proposal done. I mean, there's a deal there, H.R. 2. I mean, there is a deal, but this deal would be totally unacceptable to most Democrats.
Hey, Greg, great to get your view. Greg Valliere there of AGF Investments. MH on the options for the president.
Yeah, that's right. I think this White House is not going to shut down the border without getting that emergency authority from Congress. The former president also said he was going to shut down the border, and the only time we saw him do that is when he used Title 42 when it became a public health issue with COVID. So this president is starting to sound like the old president saying, I will shut down the border, but he's still asking for that congressional approval.
The president can't get a break. Consumer confidence starting to pick up. The economy was the big issue, and now all of a sudden immigration's catching up and the southern border's an absolute mess.
Yeah, absolutely. The White House definitely wants you to read what happened yesterday with the conference board, the Michigan sentiment. The economy is starting to feel better, but that's also why maybe people are starting to say, the economy is no longer my biggest issue. I'm starting to feel better. Inflation is coming down, or the rate of inflation is coming down. So now I'm more concerned about immigration. We should also note, and there's data to support this, depending on what newspapers you read or what television stations you watch, immigration is much more important, say, on some conservative media outlets than it is on others. So people are being bombarded with this story as well.
I just wonder if anyone's going to blink an eye at the fact that they might not pass a deal simply because it is politically inexpedient. That, to me, I wonder how that's going to play in the polls.
Isn't that just Washington for you?
Well, it's a new level of cynicism.
You know?
What is really insane is that they've been arguing about an immigration deal. This could be a generational deal. For decades, they've been talking about this, and they may blow it just because an election is coming up.
That's the latest in D.C. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Saudi Arabia is considering plans to revive a follow-on offering in Aramco as soon as next month. The multi-billion-dollar deal is likely to rank amongst the biggest share sales in recent years, according to Bloomberg sources. The kingdom raised $30 billion in its Aramco IPO 4 years ago. Shares in fast fashion retailer H&M are lower after the company missed fourth quarter profit estimates and surprised the street with a new CEO. Company veteran Daniel Erver will take over from Helena Helmerson, who saw the company lose a fifth of its value during her 4-year tenure. Erver has been with the company for a decade and for the last 4 years was responsible for the H&M brand. Activist investor Nelson Peltz has a plan to fix Disney's profitability in streaming, and it involves bundles. Peltz's firm, Tryon Fund Management, will recommend the company seek to bundle its ESPN Plus service with a larger player interested in sports, such as Netflix. Tryon controls close to $3 billion in Disney shares and is seeking 2 seats on Disney's board. And that's your Bloomberg Brief. John?
Yahara, thank you. Bramo, Back to the Future. How many times have we said that? Back to the bundle.
That's exactly what I was thinking about. Michael Nathanson, what does the successful model look like for sports? The old model, what we had before all of this stuff.
This is my big suggestion.
Exactly.
Right, it's just, it drives me nuts. Up next on the program, the Fed decision just around the corner.
He's going to be data dependent. They have 2 more inflation prints before the March meeting. I still don't think they're actually going to be cutting in March. They're not really in a rush.
Live from New York City this morning, that conversation up next. You're watching Bloomberg TV.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Tech stocks struggling just a little bit this morning, so we're pulling back on the S&P 500 by something like 0.5%. On the Nasdaq, down about 1 full percentage point. In the bond market, basically unchanged. Your 10-year, 4.0298%. Yields are going nowhere. Under surveillance this morning, the Fed decision just around the corner.
He's going to be data dependent. They have 2 more inflation prints before the March meeting. I still don't think they're actually going to be cutting in March. They're not really in a rush. The data have been pretty good. They'll be talking about talking about QT, and that will probably kick off in June.
Big banks split on the timing of the first rate cut. Bank of America and Goldman expecting March. Citi, Morgan Stanley, JP Morgan looking for June. Bruce Kasman, chief economist and head of global economic research at JP Morgan, joins us now for more. Bruce, let's talk about this. The Fed decision today, with expectations high, we get some kind of guidance about maybe a March rate cut. At the same time, on Friday, we're looking for payrolls growth still close to 200K. How do you reconcile those two things, Bruce?
Well, I think what the Fed's going to do today is open a door, but basically tell us it hasn't decided when it's going to walk through it. And I think there's a story here about inflation coming down that's encouraging them. But there's also a story about the economy looking pretty strong here, which is raising questions about how restrictive actually the 5.5% policy stance is. They're going to grapple with that, I think, for a while. I think the data is going to tell the tale. We've got, as noted, two CPI reports before the March meeting. We got 2 payroll reports. We're looking for a strong payroll report on Friday. I think most likely the strength of growth, and I think some firming in goods price inflation we're expecting is going to slow the Fed down and have them wait in March.
Bruce, we've got plenty of questions around the table about the labour market, so let's talk about it a little bit more. You're looking for north of 200K, I think, on Friday. The median estimate in our survey at the moment is 185. Unemployment's below 4%. I think you've raised the right question. What evidence is there that we are, quote, sufficiently restrictive given what we're seeing in the labour market?
Well, I think it's an interesting question. I think they will use that language in the statement today, sufficiently restrictive. Many FOMC members have been basically emphasizing that policy is at a restrictive stance and should start to come down. But the economy did very well at the end of last year. It's carrying continued strength into the start of the year. I think the labor market is showing some reduction in churning, some reduction in labor demand, but there is demand starting to pick up in some sectors of the economy. And I think job growth is going to stay strong here. I think the unemployment rate is going to stay below 4%. So I think they got a tough balancing act here. How they talk to us about that balancing act between inflation progress, strength of growth, and importantly, how they interpret financial conditions becomes really the color we're going to get today in terms of thinking about where they stand.
I find this labor market incredibly confusing right now, and I'd love your help to try to understand it because you see it as stronger than the average person on Wall Street. We've heard about those slew of layoffs, UPS, PayPal, Google, Amazon, Citi, Macy's, you can go on and on. Yesterday, we got the JOLTS data, the job openings data, and when you look beneath the hood, you can see the level of quits, people actually quitting, fell to the lowest, the rate going back to 2020. At what point are we seeing real-time weakening that just isn't making its way into the overall headline data?
So I think we have to distinguish between a normalization and weakening. And remember, the labor market was unusual over 2021 through early 2023 as we were really normalizing back after a COVID shock that was quite profound. So what I think we're seeing now is pace of job growth slow. I think we're seeing less people leave jobs. I think we're seeing wage inflation come off of very high levels. But I think we're also seeing in the high frequency data a sense that things are starting to stabilize and stabilize at a reasonably strong pace, consistent with the fact that the unemployment rate's below 4%, consistent with the fact that the economy is growing at a 3% pace here. So I think we have to be a little careful not to get carried away by momentum that's reflecting the normalization after outsized strength in the labor market over the last 2 years.
How do we know that we've really killed the potential for a wage price spiral if we do see this ongoing strength underpinning, yes, albeit some kind of peripheral layoffs, but otherwise, as you say, a very strong labor market?
I think the term wage price spiral is too extreme in terms of what the debate is right now. I think we've seen that the shocks that pushed wage inflation up, that pushed inflation up, many of them have gone from the scene, and we're not sitting with a threat that inflation is going to be 4 or 5%. I think we're debating within a range of, is inflation settling back towards the Fed's target at 2, or are we getting stuck somewhere around 3? And there's a story there which we're seeing with wage inflation, which looks like it's still running above 4%. And you're asking, well, how well is productivity doing? How much pricing power do companies have? Whether the big drops in goods pricing we've seen in the last few months is a bit of a temporary phenomenon, and how much further progress are we going to see on shelter costs, service price inflation? And these are all questions which we haven't answered yet, but we're debating with the point about, is inflation coming all the way back to the low 2s, or is it getting stuck somewhere around 3? And neither of those is a wage price spiral. That's not really the dynamic of this economy right now. But 3% inflation is too high for the Fed, and will certainly slow them down, if not stop them, if that's what the data starts to show.
Bruce, I just wonder how relevant the Federal Reserve actually is to this conversation. We've talked about them so much over the last 2 years. It's interesting, isn't it? Just how rate sensitive is this economy? If higher rates didn't slow it down, will lower rates speed it up? Bruce, I don't know the answer to that. How relevant is the Fed?
I think that's a really important question. And I would just say 2 things here. First of all, I think last year we had a very significant drag coming from higher interest rates on housing, other durable spending. Monetary policy did do damage, but it was offset by fiscal stimulus. It was offset by sharp falls in energy prices, and it was offset by still benefits of COVID normalization. I think now we're in a really interesting position because monetary conditions are still tight. Borrowing rates are still high. Bank lending standards have tightened, but financial conditions have eased a lot. And that juxtaposition of tight monetary conditions and easing financial conditions is really unprecedented, and how it plays out in economic performance is uncertain. So I think in that regard, your question is really spot on. This is a really tough economy to get your hands around in terms of what the Fed's transmission is doing as we look to 2024.
I'm so pleased you brought that up because I'd introduce another dynamic as well. This conversation today about higher real interest rates, the Fed sort of allowing passive tightening as inflation comes down and keeps nominal rates steady. Bruce, is that offset by better real incomes in America?
Well, first of all, I think it's wrong to say that there's a mechanical link between inflation and real interest rates. That depends on how people think about the forward path of inflation. It depends on how interest rate markets, as we discussed a minute ago, are feeding through the financial conditions. But I do think the point you're making is an important one. The fall in inflation is a reduction of a set of supply shocks that hit us. As that's happening, that's a boost to household purchasing power, and we can see the consumer respond to that. The good news is that income is also being generated by the corporate sector right now. It's not a move away from corporate profits as we're generating strong demand overall. And as we're generating what has been pretty good productivity outcomes, we're looking for a 3% quarterly gain in the 4th quarter productivity print tomorrow, which would be pretty impressive.
Just quickly, Bruce, to wrap this up, economics tries to be agnostic when it comes to politics, and it tries to look at these very specific issues and calibrations of inflation and labor markets, but it's hard to avoid the politics this year. A lot of people saying the Fed is going to try to get an earlier start to avoid cutting rates more aggressively right into the election. We're also, though, hearing from Congress members, Sherrod Brown, the latest, in the Senate, saying, I urge the Federal Reserve to cut rates. How difficult does that make the situation for the Fed? How does that factor into your considerations?
So I think we should not consider the Fed as having an explicit political lens in terms of their policy setting. But the Fed is operating in a political environment. And I think there is a sensitivity there that if the Fed was slow in lowering rates and the economy did falter as we moved into the election campaign season, that they'd be politically vulnerable. So I do think there's a bit of a bias here that if they think they're going to ease, that they probably started a little earlier. That does weigh on our thinking. It hasn't pushed us to think they'll go all the way in March, but I do think that's a consideration we should have in our minds.
Hey, Bruce, it's great to catch up, to get your thoughts. Bruce Kasman there of JP Morgan. We mentioned that just the other day, Lisa. When you're looking at the back half, I think it was Citi looking for more than 100 basis points of rate cuts in the back half of 2024. It does raise the question, okay, so you think we wait until June and then they go 100 basis points going into the November election? That one is a little bit of a head scratcher.
There's a should. What should they do from a purely economic level, and what will they do? And the issue is economics cannot be divorced from politics at the end of the day, because there are a lot of other considerations, especially if, to Bruce's point, they are becoming politically vulnerable if they do make some sort of dramatic action before the election.
Imagine what the other side are going to start saying in the election campaign. I just find it so tremendously unhelpful. If I was at the Federal Reserve right now, I'd be so frustrated that they were even sending those letters into Chairman Powell.
I would agree. I imagine that frustration is long simmering when the Fed has always used as sort of a punching bag for a lot of concepts that are hard to translate in some sort of mass consumption way. How do you talk about the real rate and the neutral rate and cutting rates down to that, and the disinflation versus just the overall inflation? It's not an easy political message.
Thank you, Sherrod Brown. Coming up in the next hour, Sebastian Page at T. Rowe Price, Wei Li of BlackRock, George Ferguson at Bloomberg Intelligence, and a whole lot more. From New York City this morning, good morning. Equity futures trying to bounce off session lows. We're down here by 0.5%.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If you're losing more than half the electricity you put into electrolysis, is it a viable alternative to some of those fossil fuels?
Yeah, I mean, have you heard of oil? Have you heard of gas? I mean, you convert oil out of the ground, you know, refine it, turn it to diesel, whatever you like, which is going to cook the planet. You've already lost 60 to 70%. I mean, yes, there is a conversion loss from not losing an electron going from wind and solar straight into the grid. That's why it's the lowest cost energy in the world. But there's a conversion loss. Oh my God, a conversion loss. The oil and gas sector, you know, green hydrogen's got a conversion loss. It's like putting lipstick on a pig from the oil and gas sector. You know, they have had a conversion loss since 1810, right? And remember, relative dollars, their dollar per barrel was $1,600. Let's not forget that. That's how they got going. Subsidies, $1,600. Wow, it's better than burning wood. Now the same companies stand in the road of green hydrogen and say, oh my God, it's not as efficient as us. We've only had a 200-year head start. Hundreds of trillions of subsidies, which we've swallowed from taxpayers. They should get none, and they want to do it in 8 or 9 years. You know, who would you back? I'd back us.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while this is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is the Super Bowl for investors this week, not only with tech earnings, but with a flurry of macro data as well.
The Magnificent Seven are actually delivering on the promise. These are also the companies that are growing far beyond the broad market.
I think the risk to this year is that actually growth could be better than people think, rather than the opposite.
Our take is good news is good news. It's not good news is bad news. We're done with that.
It really is a winner-takes-it-all economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 negative here by 0.5%. We can talk about big tech later. Front and center this afternoon, a Federal Reserve decision just around the corner. Will they or won't they talk about rate cuts?
And what kind of guidance can they give at a time where it's not really a question of if they're going to cut rates, it's a question of when, even though we have incredibly strong economic data and a U.S. economy that seems to be firing on a lot of cylinders.
Senator Warren would like them to talk about rate cuts. The Senate Banking Committee Chair, Sherrod Brown, would also like them to talk about rate cuts. Democrats weighing in on Chairman Powell's decision today, which is just beyond inappropriate and increasingly bizarre.
You know, I just shrugged this off a little bit because it's not new. We've heard this from these senators before, and obviously it's before the big decision day. But you have to separate the fact that Sherrod Brown is up against a huge, actually, election. It's going to be very tight for him. They are grandstanding. The issue that this becomes for Powell is it's an election year. And what does this mean the Republicans are going to say on the either side?
Well, and they've been jawboned on both sides, right? I mean, every single president seems to try to push them in one direction or another to try to help them economically. The key question, though, as Bruce Kasman was talking about, is how much does this influence the Fed to get ahead of that 3-month stretch of before the elections and start cutting earlier, despite the fact that the labor market looks strong? Yes, inflation is coming down, but still a lot of positivity out of the economic
The
front.
optics were already tremendously difficult. This just makes it harder. We said in the last hour, it's worth repeating, it was inappropriate under the Trump administration. It's inappropriate now. It's even more stupid now because they're about to cut interest rates anyway. That's what I don't get about this. You think about where the economy is. Unemployment's south of 4%. The inflation trends are improving. We're seeing inflation slow. The Federal Reserve's in a position now where it can consider pulling back on interest rates. We all know that it's an election year. This makes it so much more harder than it needs to be. That's why it's just even more inappropriate this time around.
I completely agree. It makes me wonder why. And it makes me realize it's so difficult to communicate the strength in the face of a lot of dissatisfaction among a lot of consumers, but that is starting to shift. And a number of analysts are saying, just wait, you know, in a couple months, people will get used to the 20% increase in CPI.
I think you're totally right, though. If the Fed waits to closer to the election, it's going to get very political. Remember when Biden just a few months ago said the Fed shouldn't hike anymore, and how much blowback he got just for that comment about basically seeing what everyone else was seeing, which this is likely the end of the rate hike cycle. Imagine he cuts a month or 2 or 3 months before November.
It makes it harder, that's for sure. Here's the price action this morning, just to get you up to speed. Equity futures pulling back by 0.5% on the S&P 500. Equities on the NASDAQ a whole lot lower. The tech results, Lisa, it's hard to call them disappointing. It's just disappointing relative to very, very high expectations following a monster rally across some of these names.
That's what we learned yesterday, was that expectations are incredibly high, and there's sort of a price to perfection type of feel in markets right now. So the question is, how far does that go? And how high is the threshold for some of these these names to keep driving gains, given the fact that they have been the dominant players with respect to delivering S&P returns and NASDAQ returns over the past 12 months.
That's the equity market. The NASDAQ there down by more than 1%. Let's just finish on the bond market briefly. Give you a snapshot of where treasuries are at the moment. The 10-year in America shaping up as follows. Your 10-year this morning looks a little something like this. Yields are lower by not even a basis point, 4.026% on a 10-year this morning. Coming up on the program, building towards the Fed decision with Sebastian Page at T. Rowe Price and Wei Li of BlackRock. Microsoft and Google falling in the pre-market. We'll catch up with Bloomberg's Mandeep Singh. And the latest from Boeing, we'll be catching up with Bloomberg's George Ferguson a little bit later on this morning. We begin with our top story this morning, counting down to the Fed decision at 2 p.m. Eastern Time. On the timing of the first rate cut, Wall Street is divided.
I think June is where the market has gravitated to.
Call it June, maybe July.
We definitely wouldn't rule out March.
What gets them to cut in March is the inflation data.
Our base case in the U.S. is for a rate cut in the second half of 2024.
I think the Fed's thinking probably June at the earliest.
By the end of the year, they will start cutting.
We have penciled in a May start.
We've always had them cutting interest rates around the middle of this year.
Our baseline is June.
Rate cuts in the first quarter very much seems unjustified.
Do they go in March? Probably not.
March just seems a little premature.
I still don't think they're actually going to be cutting in March.
Investors looking ahead to Jay Powell's news conference at 2:30 Eastern Time for clues on the Fed's rate path. Sebastian Page at T. Rowe Price saying his base case for the U.S. economy is a soft landing, adding it's important to stay invested and diversified. Goalkeepers are twice as likely to save a penalty if they stay in the middle of the goal, rather than dive to one side or the other. Sebastian Page joins us now for more. Sev, good morning to you. Love the analogy.
It was for you.
Thank you, sir.
Appreciate it. They studied 286 top league penalty kicks. Yep. The goalkeeper stays in the middle only 2% of the time, but they're twice as likely to block the kick.
Isn't that incredible?
Yeah, so we're in the middle. We're neutral between stocks and bonds at the moment.
Does that apply to Chairman Powell today as well, then? Stay in the middle?
I think absolutely. So you're looking at a coin flip for March in terms of rate cuts. I don't think he wants to surprise the market on either side. Historically, the Fed likes to surprise with cuts, not with hikes. So you could say, okay, historical pattern, maybe they're going to, if they're going to err on one side, it's going to be on the dovish side. But you know what? This is equities an all-time high. Wage growth, Atlanta wage trackers, 5%, right? It's a strange moment to try to deliver a dovish surprise. And I don't think the political pressures are going to influence that.
You said this in your note, and I think this is really important. Markets at all-time highs. Sounds expensive. Stocks up 2% in the last 2 years. Sounds cheap. How do you view this market? What's the best way of framing things?
You know, framing really matters, right? I'll give you another one. If you look at the Magnificent Seven being up 80%, up 107% in 2022, you'll say stocks are really, really expensive, all-time high. If you look at the MSCI All-Country World Index, which has small caps in there, it has emerging markets in there, its price-earnings ratio on my Bloomberg terminal is 19.5, and that is actually the 30-year average. So markets are kind of fully priced, but not outrageously expensive. It really depends which lens you look at.
How much does the future path of returns on this broad index really depend on what the Fed does, or are they kind of out of the picture now and it really does come down to the earnings?
I think the earnings matter a great deal, but you know, saying the Fed is out of the picture would be a really, really controversial statement because markets really follow the Fed. We're looking at rate cuts. I think the risk is to the upside on inflation. If you ask me what's my biggest risk for 2024 would be that inflation surprises on the upside. I'm not talking 9-10% like we had, but I think this is where most of the risk is, and that flows through Fed policy, maybe holding back a little bit on cuts.
So what becomes most vulnerable if the Fed doesn't deliver 6 rate cuts or 5 rate cuts, but goes for, say, 2 or 3?
You know, here's the thing, and you were talking about expectations earlier. So a really wise person once told me that the secret to happiness in life is low expectations. And you were just saying, well, Jonathan, expectations are really high. So I think if, you know, the 10-year could go up, it's the discount rate effect, and both stocks and bonds could go down. I'm not that pessimistic, by the way. You know, we're looking at rate cuts.
You've been constructive recently.
A little bit more.
Haven't you? Yeah.
Yeah, but the problem, it goes back to valuation. I mean, look at the equity. Let's talk about framing a little bit more, right?
Sure.
Look at the equity risk premium. So you take the price earnings ratio on stocks. It's like near 20 on the S&P 500. That's a 5% earnings yield. That's the same yield you get on cash. So when you compare stocks with bonds and the fact that bonds have gotten cheaper, you're in a situation where the equity risk premium is most compressed it's been since 2007. So I've gotten more constructive on the economy with everyone else and the consumer. You know, now with wages growing at 4 or 5% and inflation going down to 2%, real wages are coming up. But at the same time, all of this is priced in, so everything's awesome, right? The VIX is at 13. Tom's not here, but he would tell us the VIX is at 13.
Tom would quote that right now, you're right.
There's complacency. We're looking at rate cuts. We're looking at 10%, 11% earnings growth. Everything feels good. There's a hot war in the Middle East. And I think that's where, again, flowing back to the inflation risk is a commodity.
Well, let's go back to that hot war. Let's talk about that. I think we've all been surprised by how subdued, how calm things have been. Maybe not in equities, but more so in the commodity markets. See crude basically unmoved by all of this. You don't sound unmoved by all of this. How concerned are you?
I'm with you. You know I watch the show every day, and I know you've been talking about this a lot. I'm with you. I don't think oil prices are reflecting the risk of supply disruption. I'm not a geopolitical analyst. When I talk to geopolitical analysts, they're telling me any kind of supply disruption could be substantial, especially if it's in the Strait of Hormuz, where you get 21% of the oil flow, oil transport going through the Strait of Hormuz. The risks there are real, and the trend is not our friend. Things are escalating. They're not de-escalating. Ian Bremmer, I know is a friend of the show. Ian Bremmer put something out yesterday on LinkedIn saying, look, expect an aggressive intervention on Iranian military operations, installations, you know, in the next day or so. I don't know if he's right or not. Again, I'm not the geopolitical expert, but you can see all the risks pile up. The cost of shipping a 40-foot container from Shanghai to New York 4 weeks ago is about $3,000.
Yeah, but
it's $6,000 now.
How do you hedge that? I mean, basically, do you buy energy stocks, or do you just sit there and say aggressively neutral and happily neutral and just hope for the best?
You know, Lisa, at T. Rowe Price, we like technology. If we have it, we don't, you know, we're trying not to have a bias, but we're followed technology very closely, and we have a lot of really good growth investing strategies. Right now, our research platform is long energy. And as an asset allocator, I look at this, and this is a real signal. So in our asset allocation portfolios, we have an overweight to a real asset equity strategy, which is basically combining energy stocks with real estate, metals and mining, and precious metals. And it's maybe not in fashion right now because inflation's coming down, so it's more of a tail risk hedge, but I think it's got its place in the portfolio right now.
We saw a Houthi attack yesterday on a vessel that the U.S. military was able to strike down. We continuously see that, yet oil's not moving. It needs to actually hit supply, but aren't these vessels just going to go around Africa to continue to make sure that supply is safe?
Yeah, and that ultimately creates, obviously, inflation pressures. Look, on supply, first of all, you have weak demand, I think is what's going on here. And you also talk about the 13 million barrels a day of supply from the U.S. So this is like an all-time high. You mentioned this before. But I think it's very fragile. And any disruption, the risk is just not symmetrical. You know, could oil go back to 50 or could it go up to 100? You know, I think the risk is skewed to the upside.
Seb, stick with us. Crude is down again today by more than 1%, 76.92 on WTI. Brent crude right now, 81.92. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The PGA Tour is set to confirm approval of a $3 billion investment by U.S. Strategic Sports Group, according to the Financial Times. The investment group is led by Liverpool Football Club and Boston Red Sox owner John Henry through his Fenway Sports Group. The agreement is set to include an equity participation for the players and values the new entity at roughly $12 billion, according to the report. The House Republicans are moving toward impeaching Homeland Security Secretary Alejandro Mayorkas. A GOP panel approving 2 articles of impeachment, sending the vote to the House floor. However, the effort is likely to die in the Senate. Mayorkas is in the hot seat as security at the U.S.-Mexico border remains a hot-button issue. Media mogul Byron Allen has made a $14.3 billion offer for all of Paramount's outstanding shares. Allen is offering to pay a 50% premium for voting stock, according to people familiar with his terms. Including existing debt, the total value of the deal tops about $30 billion. In a statement to Bloomberg News, Allen Media Group says this offer, quote, is the best solution for all of Paramount Global shareholders, and the bid should be taken seriously and pursued. That's your Bloomberg Brief. John?
Yahara, thank you. Coming up next on the program, tech falling short of AI-fueled expectations.
We continue to invest responsibly in our data centers and compute to support this new wave of growth in AI-powered services for us and for our customers.
That conversation is coming up next, live from New York City this morning. Good morning. You're watching Bloomberg TV.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities on the S&P 500 pulling back by 0.5%. It is Fed decision day. Your bond market, the yield to lower by a single basis point, 4.02% on a 10-year. Under surveillance this morning, tech falling short of AI-fueled expectations.
Search, YouTube, and cloud are supported by our state-of-the-art compute infrastructure. We continue to invest responsibly in our data centers and compute to support this new wave of growth in AI-powered services for us and for our customers.
Here's the latest this morning. Alphabet shares falling in the pre-market after revenue for the company's core search business fell short of estimates. The results coming amid uncertainty surrounding Google's plans for generative AI and increased competition from Microsoft. Mandeep Singh, senior technology analyst for Bloomberg Intelligence, joins us around the table. Morning, Mandeep. Let's go through these numbers together. Yeah. They're not terrible. Strongest revenue growth over at Microsoft since 2022. Cloud services sales gaining 30%. Was this just the bar being too high?
It was, and look, if you parse through the numbers, they told us, 6% revenue from generative AI workloads. That was 3% last quarter. So what that means is it went from 2 billion to 4 billion in a quarter. Now that's NVIDIA type growth if you try to, model where those GPUs are going, and that too in inferencing. Remember, all these companies are trying to train their LLMs right now. Microsoft has a stack where they are actually deploying this in AI agents, and this is all inferencing revenue. I think where they fell short of expectations was the Copilot side. That didn't drive upside in that productivity segment, but I think if
this is any reflection, the trend is going to continue.
So this is the AI assistant on your PC. How helpful is it?
Well, so that's where, it didn't translate into revenue because people are still trying to figure out how to integrate it in their workflow. Remember, this can do summaries, this can help you do long-form searches, and it's still new. But where they are finding traction is companies looking to use their own data within the enterprise and building agents. That's what they mean by inferencing. And that OpenAI Microsoft stack is resonating in the market, whereas others are still developing. I mean, Google, I think Amazon numbers are going to be key because to me, Microsoft is clearly taking share in cloud from Amazon.
We were just hearing that too, especially because Amazon doesn't necessarily have the artificial intelligence capabilities that Microsoft and Google have. How do you gauge the fact that, yes, these numbers are completely solid, and yet people are responding badly to them? Does that mean that the market-based expectations are unrealistic? Or does it mean they've just been brought forward a year, 2 years, and things are just going to meander along in the meantime?
I mean, look at what happened with NVIDIA last year, right? It traded at the premium multiple, and they kept beating expectations. So in this case, I think, yes, Microsoft is trading at over 30 times PE. It's rich historically. But if they keep delivering on the Azure number, it's now 5% of their Azure revenue. That keeps growing at this pace. I think they can maintain that premium multiple.
There also is a question of layoffs and sort of how they're going to make their business more efficient. We heard about Google layoffs, and then this from the CFO of Microsoft, talking about the company pivoting to an AI-first workforce rather than hiring large numbers of new people to focus on the technology. Is this going to be AI person, AI at Microsoft?
I think it's too early for that. Look, they have to manage the margins. One of the biggest risks going into the print was their gross margins are going to get hurt because they're buying all this GPU capacity. I mean, remember, they raised their CapEx last night by 40%. And so this is huge. A digital transformation drove like 15 to 20% growth in CapEx for cloud guys. Now we are talking about 40% from AI. So all that CapEx is going to kind of increase the cost of revenue, and they have to manage the margins, which they said are going to grow 1 to 2%. So that's what Street wanted to hear, that margin impact would be minimal.
I'm just happy you threw a person in there. Sort of AI person.
I figure, it's basically, the desk. It's like, auto-operated. Sure. Humans sitting there lonely. That's sort of the image.
That old is, I think, 10 years away. I don't think...
That's what it's going to look like?
Not so soon.
But one thing we could get, Sebastian, I think this is a big change. Someone mentioned it in the previous hour. You could get real growth here at some of these companies, and they don't have to have the headcount grow at all, based on some of the changes we're looking at. How important is that to you?
I think expectations are high for how much efficiency AI is going to deliver. And I believe in it. I believe in the efficiency. McKinsey's putting out numbers in the 3 trillion efficiency gains. This is the size of the UK GDP. Okay, so there are high expectations. These are great companies. They print cash flows. Right now, we're neutral between growth and value. In fact, we're starting to lean towards value a little bit more. Not because we don't like AI and all the efficiency gains and the productivity gains, just because we like to lean against the wind. And right now, the value stocks relative to the growth stocks are starting to look way more.
Everyone else likes AI. Everyone else seems to be on the same side of the boat at the moment. That's been the feeling over the last 12 months. You said 10 years before we see these big changes. Where does that number come from?
Well, just looking at how AI is getting deployed. Look, right now, the focus is on infrastructure. Everyone is investing in infrastructure to feed the data, to develop their models. All this is going to translate into software. It's going to be one step at a time. And then we are going to talk about robotics or, somebody who can take the jobs or, automate that. So it's going to happen in steps. Enterprise changes happen slowly than, what people expect. But I think this is a real trend. And that's what you're going to find out, from these companies pivoting to AI.
What do you think the biggest surprise is going to be when we get the results after Meta, after Apple, after Amazon tomorrow? Who are you expecting to really sort of set a new tone other than good results, solid, just not good enough for some of the hopes and dreams?
Well, so look at the advertising side, right? We are going through a big change on the advertising side because these companies can't use third-party data anymore. Cookies are going to be deprecated. That will be a headwind for someone like Alphabet. And they are trying to pivot to AI agents to mine more data. So on the ad side, you are going to see changes. YouTube, I think, is going to blow through the numbers simply because streaming and connected TV is a real trend. You're going to see a nice acceleration on that front. So you are seeing that ad revenue shift over to streaming and all these AI agents over time, and that will be a big change.
One company we've not mentioned, Apple, reporting after the close tomorrow. Sebastian, can we finish on that? What's happened with the smartphone business and the companies associated with it? Have we met that saturated point, that saturation point we've all been worried about for a while?
Well, part of it in this case is China. Look, I think that we haven't seen, Mandeep, maybe you can comment on this, but we haven't seen significant innovation in that space in a little while. The phones are starting to look and feel the same, and you kind of reach saturation. So, Jonathan, I think we're getting there, but we're talking about a wonderful company that has a lot of innovation in the pipeline as well.
Sebastian Page, Seb, good to catch up. Great to get your thoughts alongside Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you. Coming up on this program, coming up next, George Ferguson, the Bloomberg Intelligence Senior Aerospace and Defense Analyst, joining us to break down Boeing earnings and the company's response to the 737 MAX 9 crisis. Ramo, all of that and more, but Boeing in a tough, tough spot.
Yeah, I just love the idea. This isn't good enough. Do better, Apple. This is sort of getting boring, right? I mean, that's sort of what we keep hearing, that we want something that, you know, is implanted in our brains and can
no, we
export
don't.
us.
No, we don't.
Yeah, exactly. I mean, that's what I'm saying, though. It's sort of, you know, what can you do for us now?
Mandeep? You're going to weigh in on that? You want a brain
No, I think you want the LLMs to run on your phone. That's the next step of evolution, and it's going to happen. Apple is going to do it.
Been waiting for it.
Yeah.
Not the brain implant, although some people might think that's needed. But anyway, that's a story for another time. Equities on the S&P 500, negative here by 0.5%. Into the bond market, shaping up as follows. Treasury yields coming down by almost a single basis point on a 10-year, 4.0241% on a 10-year this morning. In the FX market, the euro slightly negative. We're down 0.1% at 108.34. Waiting for the White House response to the deadly attack over the weekend, and still crude lower by more than 1%, Anne-Marie, 77 on WTI.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I I would say volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It is Fed decision day, live from New York City. Here's the state of play, the scores for you. On the S&P 500, equity futures negative here by 0.5%. Underperformance from tech in the pre-market, dragging the Nasdaq down by more than 1 full percentage point. We get more from technology tomorrow after the close with Meta, Amazon and Apple. The small caps doing okay, positive here by 0.33%. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 10-year yield is unchanged at 4.0279%. The 2-year yield is lower by a single basis point, 4.32 on a 2-year. And to finish on a foreign exchange, just a final read of things for you. The euro against the dollar, 108.34. That currency pair negative here by 0.1%. Under surveillance this morning, counting down to the Fed rate decision at 2 p.m. Eastern Time. Investors looking to chair Jay Powell's news conference 30 minutes later for clues on the timeline for rate cuts. Traders pricing in a roughly 40% chance the central bank lowers rates at its next meeting in March. But most people we spoke to so far, Bramo, suggesting we won't get that guidance later on this afternoon.
I mean, unless we do, unless in the press conference he's like, all right, March it is, guys. I mean, at a certain point, the big surprise is going to come from the press conference, because otherwise, when it comes to actually the issue from the Federal Reserve, from the FOMC, it's going to be pretty vanilla, except for maybe taking out some of the hiking bias that they had previously.
That's the Federal Reserve. Should we talk about a single name?
Yes.
Should we do Boeing?
Yes.
Yeah, not good when you see this headline, suspending forecast for 2024. Bright red across the Bloomberg terminal this morning.
And the Boeing CEO, now is not the time to share financial objectives. It is a time to be reflecting on what's going on with their 737 production and the safety and all that. Basically talking about the production rate is now at 5 per month. But really, so many questions here, even with them beating fourth quarter free cash flow and all of that. The suspension really is going to be what hangs in most people's minds.
Fourth quarter revenue coming in at $22.02 billion, the estimate 21.06. To Bramo's point, production numbers important. 737 production rate 38 per month, 787 program production rate now at 5 per month. If you're hoping for a ramp from here, Lisa, I think that's the difficult part of this. I think a lot of people hope that maybe they'll be able to ramp up production in the year to come based on the difficulties of the last few months. Maybe not likely.
This is a really tough earnings call, and this is going to be an even tougher one for the regulators, because a lot of airlines don't have a lot of choices. Are they going to wait for an Airbus for 3 years, or are they going to get a Boeing plane, albeit with some concerns around the edges? We heard from Ryanair saying, if you don't want your MAX 737, we want them. Give them to us. The price is right. How many others are going to really follow suit regardless of what Boeing does? It's sort of built-in base of buyers.
Let's get the stock price on the screen if we can. The headline crossing just moments ago, suspending the forecast for 2024. As Lisa said, now is not the time to share financial objectives. The message from Dave Calhoun, that stock is positive by almost 0.5%. George Ferguson, senior aerospace, defense and airline analyst at Bloomberg Intelligence, joins us now for more. George, we're waiting for the numbers. We've got them. Your first thoughts off the back of that?
Yeah, I mean, I think this, this earnings call, actually, is the right way to say it, is really going to be all about the future. So we kind of knew what deliveries were. We had a decent understanding of what revenues were going to be and profits. I haven't had a chance to dig through all of it. But again, I think the forward discussion from David Calhoun and the management team is going to be what's most important about this call. I think it's going to be, does the FAA agree that 38 is the current rate for the MAX production? And if that's the case, then this FAA cap on their manufacturing, numbers is not going to affect them for at least 6 months. I would hope they could get pretty well through or not complete with the FAA review of their manufacturing by then. And then it wouldn't impact their, their deliveries for the year. And I think that, largely would keep the consensus view in place. But I think just the fact that they suspended guidance means that there's some concern about that. There's concern that's going to affect their, their manufacturing cadence, and they're not going to get all those deliveries out in 2024.
Zooming out, can we just get a sense of how big a difference in profitability it would be for Boeing if their production rate were cut significantly? Their 737 production rate currently 38 per month. Let's say it goes down to 35. What would it go down to under a potential FAA cap, and how much would that potentially hit their bottom line?
So I don't think the FAA is talking about actually cutting from here. I think they're talking about restrictions on letting Boeing increase from here. So I don't see them cutting it. I mean, an adjustment of 10% or so, like you mentioned, isn't going to affect production, I think, profitability dramatically. But I think the real, what we're all looking for from this company is to see production rates up in the 50s and 60s. We want to see them, they need that increased rate to go through their supplier base, because their supplier base has been working inefficiently because they're working at low rates, not making any money. That's stressing them financially. Their supplier base is out there hiring people, getting ready to ramp to higher rates. To pause that would put some financial stress on them. So this, a slowdown in their ability to ramp up cascades through Boeing and the entire base. So what we're really looking for is to minimize this cap, have it not be an effect on their break to higher rates.
Meanwhile, the Boeing CEO, Dave Calhoun, saying increased scrutiny will make us better in a memo to employees today, also noting that the backlog for Boeing planes includes more than 5,600 commercial airplanes. Do the safety issues of Boeing really matter in terms of just the potential orders, given the fact that it's a duopoly, that it's between Boeing and Airbus and they can't seem to develop the planes fast enough?
So I think it matters less until you have these problems continue for so long, the customers start to look other places, especially core customers. So the fact that United is already talking to Airbus about A321s is concerning. I wouldn't call them an anchor tenant in the Boeing, backlog. They've got a lot in the Boeing backlog. Again, it's hard to go to Airbus and get in the queue for an A320 because I think you're waiting 5 or 6 years before you can get an airplane.
Wow.
So that keeps people coming to Boeing. But what we've heard from Bloomberg News, even over the last couple of days, is that Airbus has gone to some customers and asked them, "Hey, do you really need these airplanes in these years? We're trying to free up some capacity to go conquest a customer," which is United. So that's somewhat concerning. If you start knocking away these big core customers like Southwest, Ryanair, Copa, Alaska, that fly just Boeing airplanes, then I'm even more concerned. So I'd say right now, hasn't happened. United, a little bit concerning. If this continues and they start losing core customers, it'd be very concerning.
Elisa, as you mentioned, certainly not what we're hearing from Ryanair. Ryanair have basically turned around and said, if you don't want your Boeings, we'll have them.
Well, at a certain point.
At the right price, at a good price.
Yeah, well, I mean, at a good price, because that's what Ryanair does. I mean, honestly, though, to me, at a certain point, though, you have to wonder if they are safe and if some of the hype has sort of been overblown. You just tighten the screws, make sure to put them in, and you're going to be okay. Why not actually see people picking these up on the other side? I don't know. I mean, honestly, are others going to do the same thing, John?
George, Lisa's talked about this. Brooks Sutherland has as well. It's something we should build on. The culture of Boeing, led by Dave Calhoun. Dave is saying all the right things over the last few weeks. There was that very passionate address to employees that we saw a few weeks ago. George, what's going on with the culture inside of the company? As our friend Tom Keane would say, what changed at Boeing? What happened?
So I think it's very concerning, right? The culture used to be, I think, one of a very good engineering firm. I think that the playbook that they used prior to the pandemic doesn't work anymore. And that playbook may have been of less oversight and less training because they had very seasoned people on the line. The pandemic, and frankly, probably the max grounding prior to that, has led to a large change in their workforce. And Dave Calhoun's going to have to put his money where his mouth is and spend more money on supervision and training on these production lines, go out and cooperate with the suppliers, make sure they're in financial health, make sure they're training, make sure they're supervising, so he can ensure the product that he delivers is a quality product. And that's what we're going to know. It's great to go out and talk to everybody and tell them how much you care, but then you got to put your money where your mouth is, spend that. It means the margins aren't going to look as good. Cash flow might not be as good while you reconstitute the core of this company.
Boeing said that it's pausing 737 production for one day to refocus on quality. Is that sufficient?
One day is not going to make a difference. Again, this is all about spending the money over the long run to train people well and to supervise those lines. You can't count on really seasoned workers anymore. They've left.
George, conference call a little bit later today. Questions for the leadership at Boeing. What are they right now?
Yeah, I mean, I'd want to know what they're doing about improving that supervision of both them and their suppliers, right? They need to get down. We're probably going to find out that this problem didn't even happen at Spirit, but we knew there were other problems that happened at Spirit, and we've watched problems that Spirit's had with their suppliers affect the ability to deliver a quality 737. You know, we're going to want to know how he's going to get down there and supervise, manage, oversee all those suppliers. And we're going to want to know what he's doing on his lines, again, to make sure he's got good supervision and good training.
Hey, George, thank you. We have to leave it there. George Ferguson there of Bloomberg Intelligence. Boeing in a hot spot right now, under the spotlight. Really, really tough times for that company. Here's the latest then. The numbers, the forecast, there isn't one. They've suspended their forecast for 2024. Fourth quarter revenue, hardly talked about it. It's okay, 22.02 billion, the estimate 21.06. The production rate for two planes, pausing the 737 production for one day to refocus on quality. The production rate at 38 per month. For the 787, the program production rate is now at 5 per month. Based on what you've heard this morning so far, Lisa, questions on the call? The conference call with Dave Calhoun later?
Do you think that one day is sufficient to refocus on quality? What kind of message does that send? And then also, you know, what do you think you personally got wrong that you personally would like to change, considering that this has been an ongoing issue?
That stock is positive by 0.7% in the pre-market. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief. Here's Yahara Akez. Hey, Yahara.
Hi, John. Donald Trump has expanded his lead over President Biden in key swing states ahead of November's presidential election. The latest Bloomberg Morning Consult poll shows Trump leading in all 7 battleground states. The poll does show more than half of voters in those swing states wouldn't vote for Trump if he were convicted of a crime. Shares of Saudi Aramco fell as much as 2.2% in Riyadh on news of a revival of a follow-on offering as soon as next month. Bloomberg reports the kingdom is working with a group of advisors to raise at least $10 billion from the share sale. This comes after Saudi Arabia raised $30 billion in its Aramco IPO 4 years ago, which was the world's largest stock sale. Novo Nordisk became the second ever European company to pass $500 million in market value. The Danish drug maker expects a 26% jump in revenue and 29% increase in operating profits due to demand for its Wegovy and Ozempic obesity and diabetes medicines. Novo's CEO says the company is well positioned to grow its patient base.
We have access to some 50 million patients in the US, and we are only serving a small fraction of that. So there's ample opportunity for competition, and this is really about growing the market, serving more patients than it's a matter of market share.
And that's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, investors betting big on AI.
AI. Can't say it enough. Productivity is going to be one of the keys to growth, and these are companies that are best in their industry. They've got the financial metrics, but again, they're pushing up against valuations.
That conversation coming up very shortly, live from New York City this morning. Good morning. Equities pulling back just a touch. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Equities pulling back on the S&P 500 by 0.5%. A bit of weakness out there in equities. Yields just about unchanged on a 10-year, 4.0279%. Under surveillance this morning, investors betting big on one thing.
AI. Can't say it enough. Productivity is going to be one of the keys to growth, and these are companies that are best in their industry. You look at earnings growth, and flat's the new up. Tech earnings are revisions are up modestly, while the rest of the S&P 500 is decelerating. So this is a big test this week.
Here's the latest this morning. Microsoft and Google falling in the pre-market after struggling to meet AI-fueled expectations. Tomorrow, tech earnings resume with Apple, Meta and Amazon. BlackRock's Wei Li saying this. Excitement over AI spurred a rally in US tech stocks that buoyed the market in 2023. We upgrade broad US stocks to overweight on a tactical horizon of 6 to 12 months. Wei Li, I'm pleased to say, joined us now for more. So Wei Li, a little bit more constructive on equities in the United States. Is that all AI? Or is it other things as well?
Well, up until now, it has been all AI. And I say that both about market performance, but also about our investment view. So up until now, our overweight in AI have been offset by our underweight to broad equity market in the US. And then if we look at performance, you look at equal weighted US equity market S&P, it was up 5% the last 12 months. And if you look at NASDAQ, it was up 50%. So very concentrated market, warranting a concentrated approach up until now. But now we actually think that that rally can broaden out, not specifically about AI. There's a piece about the application of AI, of course, but more broadly about the fact that, this week is the Fed meeting, but the big meeting of the Fed took place in December, where they essentially green light equities and risk assets to embrace the immaculate disinflation narrative. And we think that that momentum can run because inflation is falling first before it then starts to rebound later this year and beginning of next year. So when that is the backdrop, this immaculate disinflation narrative can support broad equity momentum, which is why we upgraded US equity markets to not just be all about the AI piece, but the broad market as well as we consider AI.
Well, you teased some of it out. What's interesting about your call is this tactical call in the short term, 6 to 12 months, and where you see things going further out with inflation picking up again. Could you walk us through your thoughts around that? You seem to believe there's this window open at the moment to engage with the market in a more constructive way, but further down the road, we're going to have some problems. Where do those problems come from?
Yeah, so when I was in Davos, I took away this concept of normalization and new normal, which is something that Christine Lagarde was talking about as economies come out of the crises. So normalization is the journey and new normal is the destination. But because markets can only focus on one thing at a time, right now it's focusing on the journey, and the journey is not a bad journey. It's a journey where inflation falls down to 2%. It's a journey where policy rates starts to go down. But where problems can come from further down the line, I'm talking about later this year, beginning of next year, and maybe even further down the line, is when goods deflation stop bringing down inflation and persistent wage start pushing up inflation. So we actually expect inflation to fall all the way to target of 2%, but settle around 3%. So this roller coaster of a journey is something that markets are currently not focusing on because you can only focus on one thing at a time. But later this year, that roller coaster pattern is going to come into view as tight labor market continue to kind of leads to tight and persistent wage pressure. And when that happens, I think there will be a more fundamental reset. But for now, momentum can run, especially also boosted by reasonable earnings growth. So, you know, we still have the AI preference, and Magnificent Seven is expected to grow their earnings by 21% this year, a third of the index level, and tech-related themes are carrying more than 50% of the index earnings growth this year. So we still like that, but with the momentum and this immaculate disinflation narrative supporting growth markets, it could also support a bit of a broadening out of the rally that we have seen so far that has been so concentrated up until now.
So much to unpack. I want to talk more about the journey and the destination, the journey that looks good and a destination that looks a little bit more inflationary. Where does that leave credit at a time where people have been piling to top-rated credit at an accelerating pace? You've seen spreads come in to the tightest in a couple of years. You've seen companies come out and just absolutely flood the market with supply. Does it feel like that area, especially in the face of resurgent inflation, looks a little more dicey at this point?
Well, we actually prefer duration over credit at this point, precisely because of the valuation and tight spreads that point that you just made. We think that spread can widen out incrementally a little bit, maybe 20 basis point, maybe 50 basis point, one for IG, one for high yield in an inflation roller coaster type of a scenario, which is our base case. But you know, currently the narrative is not a bad one because the focus is on the journey. So whilst we don't love credit, we're not expecting spread to blow out in a risk-off type of environment. We just think that duration looks more attractive than credit, and also, frankly, if you want to take more risk, equities look more attractive as well. So a bit of a barbelling thinking about duration and equity given how tight credit is. But we think that spread can widen out, but it's nowhere close to the episodes that we experienced during global financial crisis, even as refinancing war comes into view, because we're still talking about a controlled, contained environment where cost of funding increases but not blowing out. So just on a valuation basis, not as attractive, which is why we don't love it, but we're not forecasting terrible things to happen to credit either.
When we talk about a 3% inflation destination, what does that do just generally for a mix of a portfolio? Does that mean that equities will have a better place just going forward than the traditional 60-40?
A 3% inflation environment is not a terrible environment, especially also in the context of earnings always being quoted in nominal, right? So a bit of inflation, not too much, not inflation runaway. I think that can be constructive for equity. Maybe the reset to this new environment can be volatile, but once we get there, it doesn't have to be negative for equities. On a related note, as inflation stabilizes around 3% instead of 2%, I think we're also looking at a higher neutral rate as well, which in our assessment is about 1% higher than pre-pandemic levels. And when we look at that kind of environment, back to your earlier point about credit, private credit looks quite attractive. You look at the relative yield pickup, 650 basis point above the public equivalent, and investors wanting to lock in and turn out some of the allocations. So private credit, infrastructure, those type of exposures looks quite interesting in this context.
Wait, before you go, Chairman Powell a little bit later today, no change expected in the statement in terms of the actual decision. What are you looking for from the chairman in the news conference?
Well, the big meeting is actually the December meeting. We are paying attention at this particular juncture if he would push back against still quite aggressive expectations for rate cuts. So we think that rates will be cut this year, but maybe 3 instead of the 5, 6 that markets are hoping for. So we're looking for if he would push back. But given right now the prevalent backdrop is still inflation falling because goods deflation is very, very powerful. If markets get nervous from the pushback, if at all we get that later today, that would be a moment for us to maybe even lean into the risk environment a bit more, because the prevalent narrative for now, next 6 months and beyond, is falling inflation. So if they push back, we would want to be more constructive and lean into that.
Wei Li of BlackRock. Wei, thank you. Always good to hear from you. Much more constructive on the US equity market. Bear in mind, though, this is a tactical call, 6 to 12 months. And then they expect inflation to pick up again, Lisa.
We heard a little bit of this, or the possibility, from Bruce Kasman over at JP Morgan when he's talking about once the goods disinflation kind of works its way through the year-over-year comparison figures, you start to look at the strength and you start to wonder if we do see a little bit more lift in prices to this 3% world that Wei was talking about.
Will Chairman Powell push back when he seemed to lean in that December meeting?
You know, right now it doesn't seem like they have any incentive to really push back against this because inflation has kept coming in. I'm really curious to see, frankly, the jobs numbers on Friday and how much wage inflation's come in. To me, that's going to be maybe even more important than what the Fed talks about today.
2 p.m. Eastern time for the decision. 30 minutes after that, the news conference. Then on to Friday for payrolls Friday. Tons of economic data in between as well. Let's check out shares of Boeing just briefly. Boeing in the pre-market is positive. Firmer by, let's call it 0.5%. The numbers weren't terrible for the fourth quarter, but you don't get an outlook. Suspending the forecast for 2024. Lisa, now is the time not to share financial guidance.
No, we will simply focus on every next airplane while doing everything possible to support our customers, follow the lead of our regulator, and ensure the highest standard of safety and quality in all that we do. That is going to be the appetizer to whatever we get in the earnings call later today.
I imagine this is going to be a difficult call a little bit later. There's going to be none of that great quarter stuff.
It's going to be some serious questions about how they plan to avoid this happening ever again.
It's going to be a very, very different tone. Coming up in the next hour, the third hour of Bloomberg Surveillance is shaping up as follows. Michael Schall of Market Field Asset Management, former Federal Reserve economist Claudia Sahm, and Ira Jersey of Bloomberg Intelligence. All of that and a whole lot more in the next hour. From New York City this morning, good morning. Equities pulling back as tech disappoints very, very high expectations. This is Bloomberg TV.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
This is Bloomberg.
I think it's a very, very tight rope that the Fed is walking. What we expect him to do is to lay the ground for why a March rate cut makes sense.
I still don't think they're actually going to be cutting in March. They're not really in a rush.
March just seems a little premature. I think 50-50 is a good probability.
Do they go in March? Probably not, but they likely ease at some point in the second quarter to try to get ahead of any weakness.
I think the Fed's in a really tricky spot.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market trying to bounce. We're negative by 0.4% on the S&P 500. Later today, Chairman Powell, 2 p.m. Eastern Time, looking for clues of a March rate cut.
Yeah, whether we get one or not, we shall see. The press conference might be fiery or might not be. Here's a question that I have. At a certain point, they're looking at their core PCE deflator that they typically look at, their key inflation metric, being below 2% on a 6-month annualized basis. Are they going to hold that up and say, we've got it. We've got that 2% inflation. We've got a green light to go.
New York Fed President John Williams, in the hours after Chairman Powell delivered the news conference in the middle of December. We aren't really talking about rate cuts. Do you think they're talking about rate cuts at this meeting?
100%. If they say that they're not talking about rate cuts or try to back away from that, people will laugh. I mean, that's just not possible because everybody is expecting them to probably remove some of the hiking bias from their language. Key question to me is, what is the metric? What is the key determining feature for them to pull the trigger and actually cut?
Democratic colleagues down in Washington, D.C.
I doubt.
Would like them to cut rates right now. Senator Warren and 3 Democratic colleagues together now with Senate Banking Committee Sherrod Brown in a letter to Chairman Powell. 2 separate letters, Anne-Marie, saying, let's go. Let's cut interest rates.
Sherrod Brown right here, quote, while more must be done to address the fact that costs remain too high, it is becoming increasingly evident that restrictive monetary policy is no longer the right tool. So they're edging on Powell to cut. To Jonathan, to your point, they know he's going to cut at some point. So why are they almost goading the Republicans to come out and make this an election issue.
It's bizarre. You've mentioned it a few times that the calendar might be on the president's side as the economic data continues to be okay, consumer confidence starts to turn around, that perhaps on the economic side of things improve. Then we introduce a new topic. Immigration. Our latest poll here at Bloomberg with Morning Consult, just not great for the president whatsoever. The economy is one issue, immigration another one altogether.
What we found in this poll is that actually on a top issue, economy still remains #1, but more people are starting to say actually immigration is #1. So if more people are feeling better about the economy, then what's the next issue that they care about? That's immigration. 65 and over, those swing state voters, it's a tie between the economy and immigration. When it comes to immigration, the president gets poor remarks.
All 7 swing states, Bramo, the president behind the former president, Donald Trump.
I mean, we heard that from Greg Valliere, that if the election were held right now, Trump would win. And this seems to be something that's not necessarily on the front burner yet, because we have, 9 months of an election season, a general election that's going to be the longest ever. In history. So we have a long way to go, and a lot can happen. But it's interesting to sort of gauge where people's minds are at.
Feels like we're a year in already, doesn't it? Another sort of 9-10 months to go. Exciting stuff.
I mean, I just wonder how much this is going to evolve. You know, you were talking about this earlier. How many debates are we going to see? Probably not that many.
I don't think we will see any.
Zero.
Yeah, I think there's a good chance, Anne-Marie, we won't get one.
Yeah, there's a chance that neither of these men show up for a debate.
So how does the narrative change from now until then? It's going to be really economic, and it's going to be event-driven with other potential geopolitical issues.
Absolutely, but when you come back to the economy, I'm so keen to learn about what the unemployment rate is going to be Friday, because if it's under 4%, that's 2 years exactly of under 4% unemployment rate, and this is something the Biden administration is going to take to those swing state voters and say they're delivering on an economic rebound.
The estimate right now, if you want a sneak peek of our survey, 3.8% is the estimate, just up from the previous read of 3.7. Payrolls, 216 last time around. The estimate, Bramo, 185. 185 is still okay. The focus, I think, for the bears and some of the economists looking beneath the surface is just the breadth of those payrolls gains. Really started to narrow. Just a few industry groups driving things at the top level.
Construction, for example. I mean, we've seen very specific drivers of that. I'm also watching wages. How much are wages continuing to accelerate or decelerate, as so many people expect?
Let's turn to the price action for you this morning. The stage set as follows going into the opening bell in about 85 minutes' time. Equity futures look like this. We're down by 0.4%. Yields are going nowhere on a 10-year, 4.0298%. Phenomenal just to see crude lower again by 1.3%, $76.79 on WTI. Coming up this hour, Michael Schowell of Market Field Asset Management on the Fed's path forward, Bloomberg's Michael McKee breaking US ADP data and the Treasury refunding announcement through the next hour, and former Federal Reserve economist Claudia Sahm on why she thinks the Fed should cut sooner rather than later. We begin with our top story, counting down to the Fed rate decision. Michael Schowell of Market Field Asset Management saying December's data shows, quote, considerable progress made in the fight against inflation, but it also contains warnings about the potential for a bottoming of the Fed's preferred inflation gauge, PCE deflator, early this year. Michael, I'm pleased to say, joins us around the table. So, Michael, let's start with Chairman Powell. What are you looking for in the news conference later?
I think he'll try and keep his options open. I mean, this is not a live meeting as far as actually cutting rates is concerned. The Fed's under no pressure to cut rates. It is under pressure to make a big decision in March, and I think he'll do his best to keep his options open and talk both sides of his book.
It's a big decision. Is it an easy one, based on what we've seen in inflation recently?
I don't think they need to cut rates, but they've kind of talked themselves into the position that the market has put a lot of pressure on to cut rates. I mean, I really feel that that December meeting, they moved a lot further than they had to. In November, they were still talking about financial conditions being tightened by, the 10-year yields at 5%. Comes into December with 10-year yields at 4%, and he's like, he's like, who cares about financial conditions? So I think the Fed had created something of a rod for its back. You could say it another way. The Fed feels that it's winning the fight, and it doesn't quite want to say it's won, but it wants to hint that it's winning. But yeah, they're under some pressure.
But Michael, does it matter? I mean, I know that you're one of those people who is concerned about inflation reaccelerating later this year. Is that a concern regardless of what the Fed does?
I don't think a 25 basis point cut in March really makes any difference to the underlying economy, but it does. If you're worried about asset inflation, I think it does encourage a little bit more speculation. What they don't want to be is a yo-yo Fed. They don't want to be a Fed that cuts and hikes and hikes and cuts. They really want to be a Fed which is ahead of an economic cycle, which is taking interest rates down when they have to, keeping them where they should be when they have to. Look, it's an almost impossible task. But, they certainly don't want to be a yo-yo.
When you talk about asset price inflation, I wonder if there's a lesson from the recent earnings that we got from Google and Microsoft yesterday. Is this asset price inflation, or is this fundamental hopes and dreams that are either borne out or not by the actual earnings?
Well, I think they're both the same thing, right? I mean, one's hopes are inflated by things like interest rates. In other words, the market has a chance to look at good news and bad news, and sometimes it really emphasizes the good, and sometimes it really emphasizes the bad. And there's no doubt that in the fourth quarter last year, you really dialed up the enthusiasm level, and you see it in metrics such as consumer confidence. I mean, to us, consumer confidence is an extension of belief in the equity market as much as belief in the underlying economy. And you could see that consumers never really embraced this incredible bull market since COVID. Didn't really get nervous in 2022, but it took until November, December of 2023 for that enthusiasm level to really be turned up again.
Consumers are feeling better, but when you think about how Alan Greenspan used to think of price stability, it was inflation so low that prices would not impact daily decisions of everyday Americans. I'm not seeing that in polls or stories I'm reading about how people feel about the economy.
Well, I think people got a big shock in 2021, 22, and although the inflation numbers feel better, people don't really feel better because you sort of remember what things cost 3-4 years ago, and although they're not going up in price in 2024 very quickly, they are a lot more expensive than they were in recent memory. And so, the aftershock of the big hike in prices in COVID, still remains. It's only gasoline which is kind of back to where people would expect it to be.
We've said it so many times, the cumulative inflation since 2020, the scars are still running deep. Let's talk about the stock market and get some of your thoughts on things. Framing matters, according to Sebastian Page at T. Rowe Price. He joined us in the previous hour. He said stocks up 2% in the last 2 years sounds cheap. Markets at all-time highs sounds expensive. How would you frame things in the stock market now?
Well, I mean, I think it's, again, being it's technology and everything else. I don't think tech looks cheap, and it's not up 2%. We didn't have $3 trillion companies 2 years ago, and we do today. And the concentration of ownership in that portion of the market is much higher than it was 2 years ago. But S&P equal weight, or a lot of the cyclical stuff in the S&P is not expensive, and this so far has been a pretty good earnings season for sort of general economic activity.
Michael Schau, going to stick with us on Place to Say. Marcus Schau there of Market Field Asset Management. Some of those tech names this morning, very lofty expectations, just coming short. Those stocks pulling back in the pre-market. Equity futures negative by 0.4% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hakez. Hey, Yahira.
Hi, John. Boeing has suspended financial guidance for 2024 as it signals to investors a renewed focus on safety. The aircraft maker's earnings report took a back seat to Boeing's latest 737 MAX crisis, where a near-catastrophic panel blowout on an Alaska Airlines flight triggered groundings and the FAA to step up scrutiny of the company. Fourth quarter profit and cash flow surpassed analyst estimates. Shares in Saudi Aramco fell as much as 2.2% in Riyadh on news of a revival of a follow-on offering as soon as next month. Bloomberg reports the kingdom is working with a group of advisors to raise at least $10 billion from the sale. This comes after Saudi Arabia raised $30 billion in its Aramco IPO 4 years ago, which was the world's largest stock sale. Media mogul Byron Allen has made a $14.3 billion offer for all of Paramount's outstanding shares. Allen is offering to pay a 50% premium to recent trading, according to people familiar with his terms. The total value of the deal, including existing debt, tops about $30 billion. In a statement to Bloomberg News, Allen Media Group says this offer, quote, is the best solution for all of the Paramount Global shareholders, and the bid should be taken seriously and pursued. That's your Bloomberg Brief. John?
Yahira, thank you. Coming up next on this program, it's the appetizer to Friday's payrolls report.
How much cooling do we need to see in the labor market, and can we continue to destroy job openings without destroying jobs? If we can do that, then the path to 2% without a recession should be relatively smooth.
Live from New York City, the ADP report is coming up next. Michael McKee's going to break that down ahead of payrolls Friday. Equity futures on the S&P 500 trying to bounce here, negative by 0.4% into the bond market. Your 10-year yield in America basically unchanged going into the Fed a little bit later this afternoon.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
I'm going to do this. It's a monthly event. It's something we say we don't care about. Then depending on what the number looks like, the market decides it cares about it. Equity futures going into the ADP report look like this on the S&P 500, negative by 0.4%. Tech earnings disappoint. Lofty expectations. We're down 0.9% on the NASDAQ. With the ADP report, here's Mike McKee. Morning, Mike.
Good morning, John. Well, it's a disappointing ADP report if you're looking for a big month of hiring. Only 107,000 jobs, according to ADP. That is significantly lower than the 151,000 that economists thought ADP would find. Most of the employment is in the service providing sector, 77,000 of the jobs there, 30,000 in goods producing, 2,000 of those in manufacturing. Most of that is in construction, 22,000 there. So it looks like the categories of jobs that have been looking for help have been the ones that basically absorb the new workers. Small establishments, 25,000 jobs, non-farm, or medium rather, 61,000, and large establishments, 31,000. In terms of their pay numbers, job stayers got a 5.2% increase, job changers 7.2%. So we're still ahead of inflation in terms of pay, but we are definitely not getting the kind of jobs that a lot of people think we're going to get for the payrolls report on Friday.
Not a lot of drama in markets as they parse through that. We'll bring that to you in a second, but I am curious as you dig underneath this, what your takeaway is for Friday for non-farm payrolls. I feel like we are on a broken record. We ask you this literally every time ADP comes out. What predictive features does ADP have for non-farm payrolls?
It doesn't really have much of a predictive factor. Now, remember, ADP is only private payrolls, doesn't include government, so the number is not going to match the headline payroll number. But the problem with ADP is its methodology is different than the government's, and so they go out of their way to say we're not a predictor. The problem for the markets this time is some of the numbers that normally go into the calculation of what people think we'll get on Friday have not been released yet because of the calendar, like the ISM numbers in terms of employment for service providing and manufacturing. We've had pretty much only the jobless rate numbers, and so this may affect people's thinking. But given the big jump in the jobs plentiful to get yesterday in the conference board, I think most people are leaning towards a stronger job number Friday than they are looking at something like ADP found.
And Mike, before you go, 8:30, Treasury refunding. What are you focused on given what we've already heard in the last 48 hours or so?
Well, the decline in the amount that the Treasury has to borrow has markets backing off a little bit from the idea of a major move on these data that come out at 8:30. But basically, they're looking to see if Treasury is indeed increasing the auction size as they said they would last time, and whether or not there are going to be any buybacks announced. Treasury said they're going to start buying off-the-run treasuries. The question is, when do they start doing that? And then the mix of bills and notes and bonds is going to be important to the markets, whether the Treasury is still going to rely heavily on bills to make up much of their funding.
Mike McKee, thank you, sir. Catch up with you in about 12 minutes' time. Let's go back through that data. 107, the ADP report coming in at 107,000. The estimate 150 going into payrolls tomorrow, or rather on Friday. 185 is the estimate in our survey for Friday payrolls. The previous number 216. So downside surprise on ADP. Here's the reaction to it. Slightly lower on the equity market. We were there already in the equity market on the S&P 500, negative by 0.4. On the Nasdaq, down by about 0.9. Where you do see a very subtle move is at the front end of the yield curve. The two-year yield came in just a little bit. The two-year right now is down about 3 basis points, 430.56. Down a single basis point on a 10-year maturity to 4.0184%. We'll be talking about Treasuries a whole lot more in about 11 minutes' time. Just to finish on foreign exchange, just a touch of dollar weakness, and I mean just a touch. The euro positive on the session by about 0.01% for a heartbeat. Bramo 108.45 on the euro. It's the smallest of downside surprises in the grand scheme of things.
Especially given the fact that EDP is not necessarily a predictive feature. And what we heard from Mike there was 5% for job stayers in terms of wages increasing and 7% for job switchers. It's not exactly getting back to some sort of level of wage inflation that could give the Fed true comfort. So it's not really going to move the needle.
Michael Shout of Marketfield Asset Management still with us around the table for some final thoughts. Michael, let's talk about the economic data. How much is payrolls Friday going to move the needle for you?
I think if it's anywhere between 150 and 200, it's not going to really matter. There'll be a little bit of excitement around it. Look, I think that you may get something big in the household survey. Last month we have this very weak number of people employed in the household survey, coupled with weak participation rate. I think maybe we get the opposite this time because that survey does bob around. Maybe we get more people being added to the labor force in the household survey and a better participation rate. So we still don't move U3 that much. Look, I think the labor market is basically chugging along. It's tight. We're not adding a lot of new jobs. I do think, as you said, people are going to be looking at the different sectors. The JOLTS report suggests that openings are sort of broadening in some of the sectors which haven't created any new jobs. But what nothing is showing, or no piece of data is showing, any significant layoffs in the core economic sectors of the economy. So we sort of remain in a full employment environment with plenty of wage gains running ahead of inflation. It's not a wage price spiral, but it's in no way weak.
Lisa raised this question a little bit earlier this morning. Just how relevant is the JOLTS report? Job openings yesterday, the quits rate still quite elevated. How relevant is that?
I think it's a reminder that things really aren't getting worse. I mean, I say what we see, we can have a long argument about how strong the economy is, but you can have a very short argument about how weak it is. But there's really nothing out there that suggests this economy is pre-recession.
So how much are you contrarian at this point, given the fact that everyone kind of has coalesced around that view? It's a strong economy. Things are going to go well. The Fed's going to cut rates. That's basically baked into valuations. Where do you push back?
I think the risk of a meaningful acceleration is much higher than the market and most people do. I think what we've been through is an economy which was distorted by COVID, and then we remove that distortion, which looks like the beginnings of economic weakening. I think all of that transitory weakening is now falling out of the data pretty fast, and we're going to find the sort of core economy, the non-COVID distorted economy, is running hotter than people expect.
Which raises this question about when we're going to see this in the data. Right? I mean, I think about what Wei Li was talking about, where it's the journey feels pretty good, the destination looks a little different. What's the pivot point? What are you looking for?
Yeah, I think the ISM getting back above 50 would be a sign that this destocking cycle has run its course. I think that would be the beginning of a change. I think that would feed through to all the durable goods deflation, which is really what's pulled PCE down, falling out of the data. And if service sector inflation sort of remains between that 3% and 4% level across the board, which is really what we're seeing, then mathematically core PCE and core CPI are going to be very sticky, very sticky in the high 2s and low 3s.
On the flip side, in Europe, you do see the disinflation and you do see the weakness as well. German CPI came out just a bit ago, 3.1% versus the estimate of 3.2%. Are you leaning into Europe and away from the U.S. because of that, or do you say the U.S. is really the only game in town?
I don't think Europe's giving you any obvious reasons to be there. I mean, Japan's the really exciting global market. I mean, the Nikkei, since I was a kid, the idea of the Nikkei at 38 or 39,000 was like the sort of mythological target. And, I think I'm going to see it before retirement now.
Are you looking for a hike from the BOJ anytime soon?
I think they're going to be very, very, very patient. I think
Do we need a hike to make that Japanese equity trade work? The rally we've seen in the banks, the hopes that interest rates and that regime is going to end?
I think the banks probably do, but again, the core, it looks like Japan is having a bit of a consumption-led cycle for the first time in many, many decades. You talk about a country in which consumer sentiment has been lousy for, the majority of people's lives. That might actually be changing over there.
What else is working outside of US tech and Japanese equities? What else is working?
The S&P equal weight's not bad. It's not far off its all-time high. So this has been more than a tech-driven rally. It's just tech has sort of over-rallied versus the rest of the equity market. I mean, you do see there are some industrial stocks at all-time highs. There's even portions of energy at all-time highs. So, you can look around, and the global equity market has plenty of individual names. But if you're looking for sort of institutional and retail flows into an index, the S&P and the NASDAQ still dominate everything else. And until that changes, I think the returns will show the same thing.
Michael, thank you, sir. It's good to see you, as always. Michael Schau there of Market Field Asset Management. Just to touch base with a pre-market price action across those three names that reported after the bout yesterday, the likes of Microsoft, Alphabet, and AMD. This is where we are right now. Microsoft numbers were decent. They were strong. We're down only 0.2%. Alphabet is where the question mark is. We're down a little more than 5%. I think people easily spooked around the search business, Lisa, given the potential threat that's coming from elsewhere and AI.
I think that's well said. Everyone's been talking about the sort of Google search and the disappointment for ad revenue. Let's put a number on that. It was $48 billion. That was the revenue in Alphabet's core search business. It missed the projections by the entirety, $48.15 billion. This wasn't exactly this massive miss. It's just a matter of expectations being very elevated.
Doesn't take much to spook people.
Exactly.
Around Google search at the moment, the threat of Bing and AI and ChatGPT.
I buy into it. I know you don't, but I think that, well, I mean, let's be honest. I don't like Bing a lot, but occasionally I'll try to see if,
Make it sound like a bad habit.
I just like to check out the AI-fused Bing.
Okay. Coming up next on the program, the quarterly Treasury refunding announcement and the market reaction with Bloomberg's Michael McKee and Ira Jersey. That's up next from New York. This is Bloomberg.
ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Minutes away from the opening bell, your stock market looks like this. It's pulling back a little bit on the S&P 500. We'll talk about tech earnings in a moment. Down 0.4% on the S&P. On the Nasdaq, down by 0.9. Small caps doing okay. On a Russell, up by 0.3. Lots to talk about in the bond market. Mike McKee and Ira Jersey are going to break this down for you in a few minutes' time when we get more details on the Treasury refunding announcement. That's going to come out in just the next couple of seconds. We'll give Mike McKee some time to chew over it. Yields are lower by 2 basis points, call it 3 on a 10-year. That's a break of 4%, 3.99 on a 2-year, down about 6, 4.28 on a 2-year yield. If you're looking at the FX market, the euro looks like this. The euro against the dollar, 108.45, totally unchanged. Some inflation data, Bramo, out of the Eurozone a little bit earlier. Does that move the dial for you in any way, shape or form?
It's basically pretty consistent with both France and Germany coming in below expectations. CPI in Germany coming in at 3.2% versus the expected 3.3%, 3.4%. Honestly, the disinflation trend is strong there, and they have the weakness that the U.S. doesn't have. So, you know, all the prognostications, could the ECB cut rates even before the Fed?
The euro going absolutely nowhere. I promise you that update on tech under surveillance this morning. Mega cap tech disappointing, very high expectations. Microsoft reporting revenue growth at its fastest pace since 2022, yet investors still wanted clarity on the future growth from AI. Google reporting weakness in its core search business, raising concerns as to how much it could continue to keep up with AI competition. Amazon, Apple, Meta, all on deck, all reporting after the bell tomorrow. Apple, over the last year, up 30%, Amazon up 54%, Meta up 168% over the last 1 year.
I would argue Thursday, tomorrow, is going to be more interesting for some of these tech earnings, especially with questions around Amazon losing cloud share to Microsoft, and then also this question around Apple and the hardware of it. Are we really getting bored of our phones? Are people not necessarily upgrading? Is this what we're going to hear? What about China? How about some of the questions around a number of the antitrust issues? These are some of the things that I think are going to make for a more interesting reading.
The headwinds in China are fascinating because there's some Chinese policy about having foreign tech in some certain workplaces, and we have seen some issues there when it comes to the iPhone. And this analyst last night puts out this report about the semiconductor components, and what this analyst says it shows is that shipments of the upcoming iPhone 16 will decline 10 to 15% in China.
We haven't talked about this yet. Let's turn to another story. A Delaware judge striking a blow to Elon Musk's fortune. The Tesla co-founder's 2018 $55 billion package voided by a Delaware judge after a shareholder challenged it as excessive. Musk reacting on, guess what, X, formerly known as Twitter, writing, quote, "Never incorporate your company in Delaware. I recommend incorporating in Nevada or Texas if you prefer shareholders to decide matters." Lisa, your thoughts?
I go back to what I said before. I think that Elon Musk is realizing it's a lot more fun to run a tech company than it is to run a car company, and it's a lot more fun to run something that's private than public, because right now, when it's public, he's not very happy with some of the scrutiny that is entailed. That's all I can say about this, because honestly, at a certain point, he wants 25% of the company. He wants to change into a tech company. It's a car company, and people are buying cars. Where is his stewardship of that?
Well, when it also comes to ditching Delaware, more than 70% of Fortune 500 companies are in Delaware. They're incorporated there for a reason, given their unique laws, given their unique how they deal with tax policy in those courts. I don't think he's actually leaving there anytime soon, but he did say to his ex-followers that they should weigh in. So maybe he will actually go incorporate to Texas if his followers say
that's
move
what's going to guide things.
That's what he was saying. Yeah, exactly. Vote here. 90% are like, yeah, you should move. I mean, is this all just basically? I mean, it just seems like a little bit high school. It's like vote.
High school.
It feels. You know what I'm saying? It's sort of.
Over like $50–60 billion pay packages. Slight difference.
Who's the most popular?
Well, like that. It's just sort of like respond to me, like this video, like whatever the
It should buy a sports
expression
team.
is. You think so?
Just buy a sports team.
Take a page from somebody else who we know.
AC Milan. David Rubenstein, not buying AC Milan.
I was about to say, do you want him to buy AC Milan?
If he's got the money and he's willing to spend it on players, absolutely. I'll take anyone right now. David Rubenstein, the Carlyle Group co-founder, leading a consortium of investors in a deal to buy Major League Baseball Baltimore Orioles for $1.7 billion. The group agreeing to buy a 40% stake from current owner Peter Angelos before acquiring the remaining stake when he dies. The 94-year-old bought the team for $173 million, Lisa, back in 1993.
Well, David Rubenstein is from Baltimore, and next time we have him on, we'll have to ask him
talked about this for a while, about whether he'd be interested in doing it.
And he is, and this isn't his first investment in a sports team, we know that, but it's also, there have been a series of them, which I think is kind of interesting. And I wonder how much this is about profitability and how much it's about nostalgia. It's kind of like the Steve Cohen, investment in the Mets, and that was something driven from, a certain passion.
If I had the money, I'd do the same thing.
You would?
Oh, yeah. I'd buy AC Milan. Without a doubt, I'd love to do that.
Yeah.
I'd love to do that. Even though Italian football is not what it once was in the 90s, I'd still buy AC Milan.
Your first change?
My first change?
Yeah, use it as an
I'd bring Paolo Maldini back to help me run the club. That would be my first change.
All right.
Number one decision on day one. That is exactly what I would do. Let's talk about treasuries, less about football. The Treasury refunding announcement just crossed in moments ago. Mike McKee has the details. Hey, Mike.
John, we also have the employment cost index, and between Treasury refunding and employment cost index, while you guys have been chatting, we've had a big market move. So something in there is really affecting the Treasury markets. The employment cost index comes in up 0.9%, and wages and salaries up 0.9%. Strong gains, so that may have had an impact. Now, in terms of Treasury refunding, basically it comes in as calculated, expected by a lot of people in the Treasury market after the borrowing needs number came out on Monday. $121 billion offered, refunding $105.1 billion in maturing bills and raising $15.9 billion in maturing cash. 3-year note auction next week, $54 billion. 10-year note, $42 billion. 30-year bond, $25 billion. You note that they are all increased as Treasury promised at the last refunding. They're raising the size at this particular auction, and they're going to be raising the quarterly size of auctions for most of the tenors, except for the 20-year going forward. Treasury by the end of the quarter up $9 billion. The 2-year rather, the 10-year up $2 billion. And in terms of other news there, this is the last quarter of increases to coupon auction sizes, they say. They're going to maintain bill sizes at about the same level into late March. By late March or early April, they will start reducing the size of bill auctions. Of course, April is when tax payments come in. And they're going to start doing some small value test buybacks in April. They said that they are going to start doing the off-the-run buybacks, but not yet. They'll do some tests and then announce the first regular buyback schedule when we get to the May refunding numbers. So it looks like at this point, strong economy, and Treasury still has some debt issues to deal with. But one interesting note, I'll throw this out there because I know Ira's coming on. The Treasury Borrowing Advisory Committee, which gives the Treasury Department advice on what it should be doing, notes that market concerns around large deficits, which were partially responsible for driving yields higher, appear to have waned. So less concern about deficits in the markets than there had been.
Mike McKee, thank you, sir. Initially, there was a reaction. It's faded since. We're down about 2 basis points on a 10-year. If you're looking at the 2-year yield, we're down about 3 basis points, 4 basis points lower to 429.94. I'm not really sure what that excitement was about in the last 5 minutes or so, Lisa, in the bond market.
I would suspect it has something to do with the employment cost index more than the Treasury refunding announcement, because the Treasury refunding announcement pretty much in line with where they were in November and basically where we were guided to earlier this week. The employment cost index coming in lower, though, materially lower than people expected, just sort of speaks to this fact that even though we have strength in the economy, disinflation continues to the degree that can give the Fed some comfort to cut rates.
Do you think we're overemphasizing materially lower on the ECI?
No, are you suggesting that I am?
No, just
no, I'm just kidding. 0.9% versus the expectation of 1%. Well, I mean, honestly, it's a subtle downside surprise, but it's down from 1.1% the prior quarter. So that's a material
These things
shift.
matter. I'm asking the question.
Oh yeah, just theoretically putting it out there.
Just exactly. On the equity market at the moment, on the S&P 500 down about 0.5, on the Nasdaq we're down about 1 full percentage point. Ira Jersey with us from Bloomberg Intelligence, Chief US Interest Rate Strategist. Ira, your thoughts on what we just heard in the last 10 minutes or so?
Yeah, so I have not looked at the employment cost index. I've been focused, very keenly on the quarterly refunding announcement, which did have in the details a few little surprises. So what it particularly for me, and that was that the Treasury Department is going to be increasing 2-year notes and 5-year note offerings, which will happen at the end of February, more than certainly we had expected. So they're actually increasing 2-year notes $3 billion a month for the next 3 months. So that's another $9 billion of 2-year notes. That we're going to get up to $69 billion every auction, which I'm pretty sure is a record. If memory serves, 67 was the old record. So even though deficits are certainly moderating slightly compared to what they were in the second half of last year, and becoming much more seasonal and normal, there's still going to be this net issuance that the government has to do. The other big thing was the announcement that they are going to be starting buybacks in the next quarter, it sounds like, and if they do that, then they'll probably have to increase the on-the-run coupon auction just a little bit more, and in order to conduct those programs. But keep in mind that might actually help market liquidity a little bit, which hasn't been particularly good of late, John.
What's the significance, Ira, of increasing the 2-year and the 5-year maturities in terms of just what the market is prepared to absorb? I'm not seeing that much reaction in markets, and if anything, yields were lower on those maturities after this announcement came out.
Yeah, I'm not sure why everyone decided to go buy 2-year yields, 2-year notes when they're going to be a lot more supply. That didn't quite make sense to me, and I think that'll get worked out over time, particularly when we see the auctions themselves. So I think there's two things. I think one is there's an acknowledgement by the Treasury Department that they've been issuing a whole lot of T-bills, and they don't want to have to issue quite as many as they have during past quarters. So by increasing that short end of the curve, so 2s, 3s, and 5-year notes, that will allow them to issue less T-bills. We had been expecting about $400 billion of T-bills to be issued this quarter on net. They guided to 300 to 350 billion. So you're talking about $50 billion less in T-bills than we had anticipated. So I think that's the discussion. Basically, they're starting to term out the debt a little bit here, and I think as interest rates come down further, the Treasury Department will look to term out the debt even more and increase the average weighted maturity of all of the Treasuries outstanding, because that's shortened quite a lot as they've issued a couple of $1 trillion of T-bills over the past couple of years.
Ira, I'd love just stepping back, your view on what the Treasury Secretary has done with respect to some of these borrowings in terms of actually surprising to the downside how much we're going to be borrowing in the first quarter, and then pushing that out in potentially medium-sized duration, all of these sort of machinations to try to keep some sort of calm in markets. Do you think that it seems like it's savvy, or do you think that it will sort of be the bill that hits later in the year when we have to increase issuance that much more?
Well, I think there's a couple of things. One, keep in mind that the amount that the Treasury Department raises has to do with what it thinks the deficit's going to be for that quarter. So that's not a choice that Janet Yellen or anyone at the Treasury Department makes. That's actually a choice that Congress makes, and it just happens to be that they're going to be about $56 billion less of the deficit this quarter than they had projected 3 months ago. By the way, I thought that there would be a lower deficit than there was. So it definitely surprised the consensus, but it didn't surprise everyone that there's going to be slightly lower deficit. The other thing is, and I think that there's some people in the market think that the Treasury Department is doing something unusual in issuing all of these T-bills. If you go back to the 1980s through now, the Treasury Department almost always increases the amount of T-bills as a share of their portfolio when interest rates are high, and then when interest rates are low, it terms out that debt. You could argue that maybe they should have, done a lot more 10-year and 30-year debt when interest rates were near zero. Sure, you can definitely say that, but at the same time, this is a very typical cycle that the Treasury Department does. The difference now between now and say those prior cycles is that you normally don't have growth as strong as it is with deficits as high as they are, right? Normally deficits are low when growth is as strong as we've seen it the last couple of years. And I think that that's a major difference between this cycle and others, is that you don't expect $760 billion of net borrowing when nominal GDP is running at 5%, right? That just is not a normal environment, and I think that that's a bit of a challenge for Treasury in trying to manage how much it's issuing of different debt and keeping the cost to the taxpayer in terms of interest rates low, because that's hard to do when interest rates are at 5% for short-term debt and 4% for longer-term debt.
Ira, we appreciate the modesty. It's got to catch up. Ira Jersey there. It was a surprise to you, but it wasn't to me.
Well, I mean, I understand all these small little victories. You're like, I got it right. Why didn't everyone listen to me?
I like how you're calling it a small little victory.
No, it's not a small little victory.
It's
understanding mechanics, honestly. Ira, thank you for your contribution.
Thank you, Ira. We appreciate your contributions, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. House Republicans are moving toward impeaching Homeland Security Secretary Alejandro Mayorkas. A GOP panel approved 2 articles of impeachment, sending the vote to the House floor. However, the effort is likely to die in the Senate. Mayorkas is in the hot seat as security at the U.S. border with Mexico remains a hot-button issue. Activist investor Nelson Peltz has a plan to fix Disney's profitability in streaming, and it involves bundles. Peltz's firm, Tryon Fund Management, will recommend the company seek to bundle its ESPN Plus service with a larger player interested in sports, such as Netflix. Tryon controls close to $3 billion in Disney shares and is seeking 2 seats on Disney's board. Lamborghini has sold out of its supercars until 2026. It's an indication the world's wealthiest consumers are showing few signs of being affected by a broader global slowdown. The Italian luxury car brand posted record sales of more than 10,000 vehicles last year, driven in part by the introduction of its first plug-in hybrid model. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, looking ahead to a Fed rate decision.
What the Fed's going to do today is open a door, but basically tell us it hasn't decided when it's going to walk through it. And I think there's a story here about inflation coming down that's encouraging them.
That's coming up next on the program, live from New York City. You're watching Bloomberg TV.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the 2 big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
from New York, counting you down to the opening bell, 42 minutes away from the cash open. Equity futures on the S&P 500 negative here by almost 0.5%. Under surveillance this morning, looking ahead to a Fed rate decision.
What the Fed's going to do today is open a door, but basically tell us it hasn't decided when it's going to walk through it. And I think there's a story here about inflation coming down that's encouraging them. But there's also a story about the economy looking pretty strong here, which is raising questions about how restrictive actually the 5.5% policy stance is.
The Federal Reserve expected to hold rates steady, but the timing of cuts remain in question. Senate Banking Chairman Sherrod Brown saying this: while more must be done to address the fact that costs remain too high, it is becoming increasingly evident that restrictive monetary policy is no longer the right tool for combating inflation. Claudia Sahm, former Federal Reserve economist and founder of Saab Consulting, a good friend of this program, joins us now. Claudia, wonderful to catch up with you. We have to tackle the politics first, if you don't mind. How unhelpful is it to hear from senators weighing in on Fed policy ahead of the Federal Reserve, which is gearing up to cut interest rates anyway?
It's not a good thing. I mean, everybody can express their views, and we've certainly heard it on both sides of the aisle. Everybody's got an opinion about what the Fed should do. I do also. And the Fed is going to have to try really hard just to not listen at all. But the Fed is political. It's in D.C., not partisan, but they are in the crossfire, and they always are. In an election year, this is not helpful given the big decisions they have, but this is where we are.
You think they should go sooner rather than later? Do you think the calendar influences that in any way, shape or form, just in terms of the election being in November? If you need to go, let's get moving.
Not so much with the timing. And honestly, the biggest factor this year is the Fed. I mean, they drag their feet, and it's clear that that's where they're headed. So it's more about the calendar is whenever you start cutting, that is going to have some constraint on how much you can cut for the year. And the politics are already going in full force. So there's nothing about the calendar that's going to help them on that.
So let's talk about your opinion of the Fed, because you said that you have one, and I'd love to get it. Neil Dutta has an opinion of Renaissance Macro, and after we got the ECI data and some others, he put out with all caps, doves have all they need. The Fed cannot rule out March, nor should they. Do you think that there has been a green light in the recent economic data for the Fed to start cutting in March?
I don't think it matters. They should be cutting this afternoon. Frankly, the case is there. Inflation is coming down. We're headed to dual mandate. Nobody's asking for 200 basis points this afternoon, right? 25 basis points, get moving. And yet I see May as the absolute earliest that the Federal Reserve is going to cut. They just, it's not Fed-like to get going. They are always behind the curve. And they're going to do it here now. It may not matter much. I worry a lot about in credit markets because I think that's where it would matter first, them being slow. And yet, I mean, come on, it's the Fed. But they have the case. Neil is absolutely right. The case is there.
What's the argument to really start cutting sooner? If you have credit markets that are wide open, you have financial conditions that have gotten really quite easy, you have people where you get economic confidence picking back up. MasterCard just came out a bit ago. People still spending. What's the argument for the Fed to make a move?
The dual mandate. I mean, by the time they get to 2% inflation, and it's kind of hanging at 2%, they should be out of the way. Now, we can argue about what that restrictive, not restrictive interest rate is, so the infamous R-star, but there's no way that we're not above it. I mean, the Fed says that too. If they don't get going with the cutting and we see the inflation rate really coming down, they're going to miss it. They're not going to be out of the way when we get to 2%, and that's a big problem for them. And Jay Powell said at the last meeting, and this was so important, that the Fed does not think to get inflation down, they have to have slow growth. And that was a big change for them. So I should be on the prize here, 2% inflation.
That final point is such a good point. Can we just talk about the other side of the dual mandate and talk about what's happening in employment? In the labour market, Claudia, when you look at the surface level stuff, things still look okay. South of 4% unemployment, jobless claims in at around 200K. You're far better than me, far better than most, actually, when it comes to the labour market. Claudia, what do you see right now? Do you see signs of weakness emerging?
There are signs. When you look under the hood, there are places where they're showing some weakness. Now, I still look at the labor market and say, this is good, and it has a lot of strength and is still in a resilient place. we are in this place where it really looks like we've rebalanced. Like things have gotten, the job pace, it's slower, absolutely, than a year or so ago. And yet it looks like before the pandemic. Quits rates, a lot of pieces look like before the pandemic, which when we had a good economy. But as things are slowing, it could be rebalancing. That's what I see. But it could also be this slow grind down. And once it gets going south, it's really hard to stop it. So yeah, there's signs, and we're going to see more on Friday as to how much these are really flashing yellow or not.
Just to put a bow on that, Claudia, you did coin the SOM rule, and I know you've pushed back. It's, in terms of just how it's applied. How close are we to triggering that kind of increase in unemployment, just the pace of the increase? How much are you looking for this Friday?
So we're nowhere near triggering the SOM rule. The unemployment rate smoothed out is up 0.2 percentage point relative to a trigger of 0.5 percentage point. Like if we manage that trigger on Friday, I will have passed out dead or something. Like there's just no way we have those kind of moves in, and I'm not kidding. So I think the consensus is we see a little bit of a drift up in the unemployment rate to 3.8%. But I mean, come on, we have the longest stretch now below 4% unemployment since the 1960s. This is really good.
Pretty amazing. Claudia, you're one of our favourites. It's great to hear from you on Fed Decision Day. Thanks for being with us. Former Federal Reserve economist Claudia Sahm there. You mentioned Neil Dutta. Neil wrote in just on the Bloomberg moments ago, the Doves should be fighting tooth and nail. It's over.
Well, he's trying.
It's over. I think Claudia would agree with that as well.
Yeah, she basically said they should cut this afternoon. I love Neil. They just all caps, Doves have all they need, go. Here's the question. What's the risk of not going now? Is there a material risk of that downturn? We have heard that from absolutely very few people. I mean, some people, I guess Tom Cosmo, I was going to say no one, but I can point to a couple people who are worried about the downside. But otherwise, we're not seeing signs of that, which is a reason why people say it's not necessarily as balanced to sort of goad them into rushing to cut rates.
If you wanted a good roundtable right now, I think Claudia Sahm, Neil Dutta on the one side, Sebastian Page, Wei Li, both of them from earlier in the program. They don't think it's over. They think there's a window here where it feels good, but ultimately it's not over.
That we're going to that glide path of 3% inflation. Even if we hit the 2% target, then it's going to creep up higher. This, to me, is going to be the conversation later this year. I think a lot of people in the markets are thinking, okay, well, we don't have to worry about that then because now we can just carry on with the momentum that we've got.
I need about a minute just to go through the promo for the Fed show a little bit later. The lineup is absolutely stacked. So 1:30 Eastern time, our coverage begins. Special surveillance special of the Fed Decides. We'll be joined by JP Morgan's Priya Misra, Matt Lazzetti of Deutsche Bank, former Fed Vice Chair Richard Clara, Diane Swank of KPMG. We'll break down the decision at 2 p.m. Robert Tipp of PGIM, Michael Gapin of Bank of America, former New York Fed President Bill Dudley, Jeff Rosenberg of BlackRock, and a man called TK.
Yeah.
All of that and a whole lot more coming up a little bit later this afternoon.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come. Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City, for our viewers worldwide, I'm Menace Cranny in for Jonathan Ferro. Tech, the ego has taken a bruising. The field of dreams has just been punctured. Tech is bruised. Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Big Tech delivers a big letdown, pulling futures lower for a second day. This as investors turn their attention to the Fed. We begin with the big issue. Big Tech, big miss.
These are good numbers, but the expectations were huge. And there's a real issue of traveling and arriving. You know, the markets have been rallying strongly, not just in mega cap tech, but broadly speaking. These are not bad numbers. These companies are generating fantastic revenue growth and are in a very strong position. But I think, you know, the upside from a market perspective in the short term was likely to be limited given the expectations that have been priced in.
Well, let's bring in our roundtable. It is BlackRock's Kate Moore and Jim Bianco of Bianco Research. So, as Peter just said, as travel and arrived, the expectations were so high. When you look at this mini drawdown case, it's almost sort of like, I think it's sort of quite a relief, really, to see a little bit of the air come out of the tires.
Yeah, I have to say, it is a healthy bit of a drawdown. You know, there was a lot of angst in the last couple of weeks about how strong the performance of tech had been year to date. We know it's the best performing sector, up over 6%, and taking a little bit of air out makes sense. But let's be very clear. The earnings that came out last night were excellent earnings by any measure. They just maybe didn't meet the loftiest of lofty expectations. And we have a lot more tech earnings to get through this week. I think we're going to find that the sector is in extremely strong health and that there's a lot of opportunity to stay invested in tech throughout the course of 2024.
So, Jim, good morning. Good to see you. For you, these record highs in equity markets that we've seen cascade in pretty much every day last week, it's had a slightly different ramification for you on the corporate bond issuance. That's at record highs. What are the ramifications of high equity markets for you in the credit space?
Oh, I think that it is a loosening of financial conditions and the ability for companies to want to not only issue, but have it issued. And we've seen that with record corporate bonds. And I think it filters through to the economy as well and really makes the case that the Fed shouldn't be in any hurry to cut rates. I know they like to talk about being restrictive, but with record bond issuance, with an all-time high in the stock market, with economic data beating left and right, I'm having a hard time finding what exactly a 5 to 5.25 or 5.25 to 5.5 funds rate is restricting. So when you look at what's happening with equities and with corporate bonds, you have to kind of turn around and conclude that the economy's okay and there shouldn't be any hurry for them to cut rates.
Well, you bang on the money. It's not restricting anything because we have COVID hangover. We've got a structurally different work week, and we've got a fundamentally different economy. Let's dig a little bit deeper into these tech earnings because they have skewed the risk this morning. We're off to a shaky start. Alphabet, Microsoft, AMD, all dropping short of their lofty expectations. Mandeep Singh is Bloomberg Intelligence. He joins me now. The nuance you say is to understand perhaps the difference between Microsoft and Google in terms of AI. Just differentiate for me.
Yeah, I mean, look, in the case of Microsoft, we know AI contributed about $4 billion in revenue, and it was 6% of their Azure growth. So clearly, and it doubled from last quarter. So a lot of momentum for Microsoft, and not to, just with large language models or copilots. It's that entire stack. In fact, they gave a metric. The number of enterprise customers for Gen AI were around 51,000, and 1/3 were new customers. That tells you something. If Microsoft is signing up new customers, I mean, given their enterprise footprint, the Gen AI thing is real, and it's helping them expand their customer base. So Microsoft is becoming the most sticky product when you think about it from an enterprise perspective, both on the application side and the infrastructure side. In the case of Alphabet, I think the search is the real concern, how much it could get disrupted, but the cloud revenue did go up, and that's what Street wanted to see.
Do you think the advertising was that disappointing? I mean, on paper, it doesn't look huge, but we've written a monstrous amount about the disappointment there.
Yeah, look, they have the 90% plus share, and they keep growing, in double digits. The concern is, can they sustain that double-digit growth, or it's going to taper off to high single-digit? And I think based on the commentary yesterday from management, it sounded like they said the base is too high, and search may not be growing double digits in the next 2-3 quarters, which is why I think you saw this kind of reaction.
Okay, it could be a long variable lag in the advertising and on the search side. Mandeep, thank you very much. Mandeep Singh there on the tech reporting. Let's take it back to BlackRock's Kate Moore. Kate, this is what you write. We entered 2024 with a pro-risk portfolio on the back of a resilient U.S. economy, supportive disinflation trends, and a core belief that peak rates are behind us. As such, we've been tactically adding to our portfolio risk, capitalizing on cheap vol and using derivatives. I mean, this must be one of the days that you relish. A little bit of a spike in vol, but things cheapen up. So where do you deploy to broaden your reach on days like this?
Yeah, so I would say there hasn't been a lot of trading in the last 2 days as everyone's been waiting for the FOMC decision and, of course, the 40% of S&P 500 earnings that are getting released this week. So there's so much to digest, and positioning super aggressively ahead of that doesn't always make a lot of sense. That said, we have been, to my note, pro-risk and have had higher beta than normal because we've seen great opportunities across the equity market. I want to go back to a point that Jim made earlier, which is that higher real rates have not really been cramping the economy. And we've seen this across a wide variety of sectors. Company management teams have been telling us activity looks good, our prospects look strong, and even with these higher rates, we still see prospect for significant earnings growth in 2024 after earnings contraction in 2023. So it's kind of hard to step away from the market. That said, we have been using derivatives very aggressively. We see volatility in certain areas as being priced very low, and it's been a great opportunity for us to buy vol at those levels.
I'm curious, Jim, for you, when you see a lot of people come on one after the other and talking about low vol, low MOV, low VIX, a prime opportunity to pick up protection. In that lowish volatility regime, how does that manifest itself for you?
Well, it does because of the stock market going up. There is an investor skew involved and it goes down. But I've always contrasted it with what you see in the bond market. And in the bond market, the volatility numbers are above average. And in the last month or so, they've been way above average. And you've seen a lot of volatility there and in the commodity markets, too. I mean, we've almost grown accustomed to, take one example, crude oil moving 2 or 3% a day. That, I'm old enough to remember when that was a big deal. Now that's Thursday or that's Wednesday in the crude oil market. So yes, the vol numbers are very low in equities, but when you start drifting away from them and you start looking at fixed and you start looking at commodities, those vol numbers are much, much higher. And I think that represents an uncertainty about Fed policy, about global monetary policy, about the state of inflation. The stock market has decided that it's gone. Inflation is gone. The Fed needs to cut rates. Everything's okay. But I think when you look at commodities and fixed income, they're not so sure.
Jim, don't worry, you're not the only one that can remember moves in crude oil. In 1991, I think I got my first Bloomberg, and I understand what a crack spread was. Traded it very badly. The Band-Aid's about to come off in the Bank of Japan. What's that going to do to dislocate flows around the world in the bond market? Jim, briefly.
I think that it may be a big dislocation because the Bank of Japan or Japanese are the largest treasury buyers in the world, even larger than China. If they allow their rates to go up and compete with the U.S., you're going to see money being diverted back to Japan.
Kate, you're a buyer of Japan. In what kind of scale? I've had various people that talk about it since I came to live here, but it's not a big theme. You are behind Japan in the medium term?
Yeah, look, and we've had a modest overweight to Japan, a modest overweight that we're looking to add to, and particularly to domestic-oriented stories. We're seeing, greater momentum in the Japanese equity market and in Japanese consumption, and we think it makes a good relative bet and a balance to what is also our highest conviction country weight, which is the U.S. Mm-hmm. The one thing I will kind of note here is that a lot is going to depend on the inflation trajectory. We have great hopes for a little bit of inflation in Japan and this rotation in terms of BOJ policy. But at the very heart of it, we see strong fundamentals for Japanese companies. And I think earnings, whether that's in Japan, in the US, or in pockets of Europe, are going to be what leads the equity market higher this year.
Okay, hold those thoughts. Kate Moore and Jim Bianco, my guests this morning on the panel. Let's stick with stocks. Guess what? Ahead of the opening bell, bit of a thought. Could be tech, Abigail Doolittle.
It could be tech, and it is tech, Manus. Let's start off with some of those shares that are really falling and pressuring some of the major indexes, starting off with the shares of Alphabet down more than 5%. This, of course, after the Google ad revenue missed on tepid search growth. Investors not liking that, down 5.6%, given the fact also that the stock had been up more than 8% year to date alone. Just not good enough. AMD down 4.1%. Their fourth quarter was lackluster, and the revenue forecast disappointed. Microsoft kind of flipping between gains and losses. They beat, but against the backdrop of a high bar expectation quarter, it seems investors maybe wanted a little bit more. Some analysts are saying that the cloud disappointed, and others are saying that it was just a little lackluster overall. Paramount Global, on the other hand, look at that stock, soaring up 15%. This is media mogul Byron Allen has made another bid for Paramount, $14.3 billion this time. That equates to $28.58 per share. As you know, Manus, the stock not even 40 to 45% of the way there, suggesting investors think that this deal may not get done.
Okay, Abby, thank you very much. Yeah, Microsoft adding 51,000 customers on the AI side, as Mandeep just pointed out. Coming up on the show, you got it, we're counting down to the Fed.
The Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
Looking ahead to Chair Powell and the Fed. That conversation we're counting down on Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. some of the things that one reads about now remind me of growing up in Mississippi.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Watching the Fed, of course, we know that the Fed isn't going to do anything. It's probably going to remain on a pause, on hold a little bit longer here.
The Fed's in a really tricky spot.
It's a very, very tight rope.
Officials will more clearly outline how they're thinking about rate cuts over the next year.
They'll move to a more kind of balanced language.
We're going to hear Powell more in this careful camp.
It's, in Powell's best interest to be neutral here.
They may send a signal to help people begin to ground their expectations.
Probably going to maybe pull back a little bit in terms of the expectations that is already in the market about March.
The Fed's just going to be essentially validating at least some of what markets are pricing in.
They'll keep the door open.
I think he's going to say that there's been progress.
If you look at the amount of progress you've had on inflation, it's been really substantial.
The Fed can take some credit for that and some comfort in that.
Things are moving in the right direction.
The Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
Nobody's taking a victory lap yet, certainly not at the Fed. The investors are looking ahead to the discussion today. The latest rate decision will come at 2 p.m. Eastern, followed by the chair, Mr. Powell's news conference 30 minutes later. Bloomberg's Mike McKee joins us from Washington, D.C. with a preview. So, Mike, what will the shift in the nuance be, perhaps, in the FOMC statement? Let's start there, what we're punting out as the shift, first of all.
Yeah, Menace, that's a good way to look at it, because it's been since July that we've been talking about it's more important what the Fed says than what they do, since they haven't raised rates since it was warm in the summertime. No rate move again expected today, but it is a question about what they say in the statement. They've been talking about additional firming for all of those months. Now that part of the statement is likely to go away, and the Fed will find some way to massage it to suggest they have hit the peak. There are no new economic forecasts and no dot plot this time, so we probably aren't going to have anything to chew over about what the Fed thinks is going to happen. And so we probably won't get any guidance on rate cut timing, possibly some talk about the balance sheet. Jim Bianco was talking a little earlier about what is the Fed restraining? Well, maybe job growth. ADP comes in low, 107 this past month. That is well below what was anticipated. And if that's the case, then we could see the market be wrong about what it thinks is going to happen on Friday, with a forecast for 185,000 jobs and a jump in the unemployment rate. Also, no real change in the year-over-year average hourly earnings. But there was good news from the ECI today, the Employment Cost Index. It went down, not down, but it grew at a slower pace, 0.9%. That is still ahead of inflation, so you're still getting a benefit there, but it on a year-over-year basis is annualized to about 3.5%, which is what the Fed has been looking for in employment compensation. So there is a slowing economy, and we'll see on Friday if we have a slowing labor market. The Fed at this point can stand pat and probably not say as much as people would like them to, Manus.
Probably, Mike. They'll be pushing them on timing and on QT. Mike, thank you very much. A very clean run through on the data. My guests this morning are Jim Bianco and Kate Moore. Jim, I want to take it to you first of all. I mean, there's a fine line. There's a wonderful phrase the Brits use, which is, loose lips sinks ships. How does he thread the needle today to deliver neutrality and, I presume, optionality for March? Should March still be live at the end of this press conference tonight, Jim?
Well, March is live now. If you look at the latest probabilities from the market, it's essentially 50-50, and what he says will have a long way as to which way it goes. I think he preserves his optionality by stressing, you know, the old saw that the Fed likes in data dependence. If the data continues to warrant the idea that inflation is moderating and the economy can see some kind of room for them to lower rates, they will. I might add that 2 weeks ago, the probability that they were going to cut rates in March was 85%.
Yeah.
And now we're down to 50-50. And I think that represents that the data has been a little bit stronger than the Fed needs. So if that continues with that stronger data, then all of a sudden March might be pushed into May.
Kate, you know, I asked this to many equity investors. The velocity of the equity rally, the ramp in the NASDAQ, the ramp in the technology side relative to value has to a certain extent been predicated on rate cuts. How much will it interfere with your overall thesis if it's 3, 5, or 6 rate cuts? I know there is a differential between 150 basis points and 75 basis points, but materially from an equity investment point of view, how much difference will that make?
Yeah, it will make very little material difference, in my view, to the equity market direction over the course of the year. I mean, we're at a point where we're talking about when, not if, the Fed adjusts policy rates over the course of 2024. And most importantly, the leaders across technology and across these other sectors are not dependent on lower rates for performance. What we want to see is kind of a glide path of the economy where we have growth, but perhaps a modest deceleration. The consumer looks good. Demand for things like AI, software, and tools continues to stay robust. I mean, that's the best story for their earnings in the S&P 500. What I will say is, you know, this is a very different market from balance sheet, from leverage, from dependence on debt than it had been in previous rate hiking and rate cutting cycles. So we need to acknowledge that there is not an easy comparison and acknowledge that the health of these companies, particularly in the tech sector, the return on invested capital, the free cash generation, are at levels they've never been before. So I don't want to sound like a wild bull here, but I think we need to be constructive. There's a fundamental reason, not just a rate cut reason, why these equities are outperforming. I think we're going to get fits and starts, periods of trading consolidation, and perhaps we're entering one of those right now. But we'll continue to make new highs throughout this year, and it pays to be risk on.
Yeah, I think for most of us, it's probably just that hesitancy and a sharp intake of breath at the speed with which we got here. You know, we got to the end of 2024 targets for a lot of houses almost done and dusted with very little breath left on the upside. Jim, can I take it back to you? One of the best lines I've heard, and I've heard many, is from Claudia Sahm. Of course, she is the author of the Sahm Rouge. She said the Fed should just get out of the way. They've got a dual mandate. One is inflation, that's being behaved. And the second is full employment. And we're at it. Get out of the way, Fed. But can you be that bullish? And therefore, what does that mean for loading up on this mini handbrake turn in yields?
Yeah, I think that the risk of that idea that the Fed needs to get out of the way is the presumption that we've got inflation licked. I know that everybody says we've got inflation licked. They also said it last year. They said it 2 years ago within transitory. And it just continues to be the story that there isn't an inflation problem. Count me in the camp that thinks that there still is. Yes, we had transitory inflation. It got us to 9%. But once that smoke dissipated, I still think we're in a 3 to 4% inflation world. I think the last mile has already been run, to use that metaphor, and that we're probably near the lows of inflation. And that's going to be a problem for the Fed. Now, if that is, then this presumption, get out of the way. Let's just cut rates. Let's just declare victory. Could look a lot like what we saw in the mid-'70s when the Fed did the same thing, and then you fostered a resurgence of inflation. So let's be sure that inflation is done and behind us. And I think that we're in a post-pandemic world and that the economy's changed enough that people are more in a spending mood, that if you give them more stimulus, you're going to see more inflation. And that's what my concern is.
By the way, I want to remind you, the world didn't stop at 5% rates in the 90s or 6%. The world did continue to run. And we bought houses and we did different things. So, Kate, let me bring it back to you. I want you to live in a world of where the last mile is tough and there's a stickiness at 3%. It's not that much of a challenge for you in 30 seconds.
Yeah, I don't think it's much of a challenge at all. And as I mentioned, companies have made significant changes to the way they approach debt, termed out their debt, and locked in very low rates. We know that for the S&P 500, the average effective debt rate is around 3.3, 3.4%. So I think we're in good shape. A 3% environment where we have moderate growth and consumer stays high and we have lots of reasons to be optimistic is a great environment. I'd rather be there than a 0% where we're concerned about recession.
Shape up and look large. Kate and Jim Bianco, my guests this morning. No fear in either of you. Coming up on the show, your morning calls with JP Morgan's Bob Michael on why he sees a soft landing in the U.S. economy. That conversation next. Coupon hunters of the world unite.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Stock set for a lower opening. It's like a field of dreams where tech came to be pricked this morning. You've got Tesla under pressure on a pay deal. You've got AMD down on the guidance. But let me get you up to speed with your morning calls. Here's a look at what some of the analysts are scribing from the street. First up, Morgan Stanley downgrades Sophie Technology to underweight, seeing headwinds in the near term to revenue growth. Next up, Barclays downgrades Verizon to equal weight, expecting limited upside given the stock's rich valuation. And finally, Argos downgrades UPS to a hold, highlighting the company's disappointing results, the tepid outlook despite the job cuts that we saw yesterday. Coming up with me, it is JP Morgan's Bob Michael, setting the stage for the Fed. Are you nervous?
Regional sports networks. There's a lot of, it's a business that seems to be collapsing.
leagues have sort of toyed around with. Should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Technology market has had a puncturing of optimism this morning. The Nasdaq set to open down by 1%. S&P 500 also lower. Do you see this as an opportunity to step in? If you get a drawdown on Microsoft, on Alphabet, on the likes of Tesla, on different stories, is this your opportunity to step in and buy the proverbial dip? Camera's out, the bell is ringing, the moment is live. We're live for equities. It's a lower opening. And in terms of one stock to watch at the open, I mentioned it is Alphabet, the search engine revenue missing the analyst estimates. That overshadows the otherwise strong end of the year. Abigail Doolittle can disaggregate the two. Abby.
Well, as a result of that disappointment, Manus, we do have the stock down more than 5%, heading to its worst day since October of last year. And relative to the quarter that was, I would describe it as messy. There are bright spots, but in terms of adjusted earnings, it actually missed. Revenue did beat, so that was solid. But the big point of contention, as you mentioned, is the fact that the ad revenue missed, not in a big way. $40 billion missed the estimate just slightly, but investors wanted more. It does suggest that the search demand on Google, because it was the Google ad revenue, that it's waning. It's not quite as strong. And one analyst is describing this from the standpoint that that is the cash cow as they try to move more into AI. A lot of analysts think that they're behind on AI. Their Gemini product, of course, launched recently. That it's just not great to have these kinds of ripples with their cash cow stream of business, that revenue line, that ad revenue from Google. As for the stock, 9% up into the year, into today, up more than 50% over the last year into today. Price perfection, they didn't get it. But there was that big bright spot that I think you were alluding to, Manus, and that, of course, was the cloud revenues there more than doubled. But against the backdrop of that disappointing search and ad revenue outcome, investors just don't care. The stock down 5.4%.
You're right. And then, of course, you look at Microsoft, you would begin to understand. We'll stick with that theme. Abby, thank you very much. It's about the strength of the revenue. There's a strong revenue growth there, but it was the cloud growth that disappointed some investors. Ed Ludlow is with me. Ed, I mean, if you look at the AI component here, it is boosted sales by 6%. But there seems to be a disappointment, not so much with that number, but with the lack of huge forward guidance on AI.
Yeah, high bar quarter, elevated expectations. Dan Ives at Wedbush has this note that Satya Nadella delivered a masterpiece that should be in the Louvre. The market doesn't agree. We're basically flat on the stock. But you are right. What they needed to do is demonstrate how all the hype around AI and the investments they've made in AI translate to both the software that they sell to customer and enterprise and on the cloud side. And so a top and bottom line beat. Azure, the cloud unit growth was 30% in the quarter, up 1 percentage point sequentially from the prior quarter and ahead of estimates. And you're absolutely right that Amy Hood, the CFO, told us in an interview, in terms of size and scope, that AI had around a 6 percentage point benefit to that growth rate on Azure, but very elevated expectations. And I guess one looks at the run-up in the stock toward the end of 2023 and the beginning of this year, taking Microsoft to that $3 trillion market cap and above Apple as the world's most valuable company, and then compare and contrast with Alphabet, for example. You know, when I interviewed Ruth Porat, the president and CFO of Google or Alphabet, they had similar growth in cloud and gave some evidence that AI was a contributing factor there, just not as much evidence as Microsoft gave. The muted reaction is we're up 0.3%, but I think Microsoft this morning probably still the winner of the 3 AI names that reported last night.
Listen, I think it's very much about front-running the scale of delivery of AI, and that's going to be at a different pace in different companies. This is not an NVIDIA story inside Microsoft. This is an AI adoption story. Let's talk more about the chip story. AMD giving a weak forecast, disappointing investors despite the new prospects for the, you got it, AI processors. Katie, translate for me. Good morning.
Well, man, it's 24 hours ago. We were talking about that hype around AMD's new MI300 chip, and as you're seeing in the shares this morning, that alone wasn't enough to offset the weak guidance that we got from the company. Specifically here, the chip maker said that first quarter revenue will be about $5.4 billion. That is well short of the $5.77 billion that analysts had been looking for. And really, this report echoes concerns from what we heard from Intel last week, that you take a look at customers and they're holding off on buying PCs, servers, and game consoles, and those are AMD's core markets. So that's weighing on the stock this morning, even though you did have analysts cheered about its push into AI accelerators, like you mentioned. Specifically, we're talking about that MI300 chip. That's designed to help companies develop their AI models, and it's supposed to help AMD compete against industry leader NVIDIA. And it does see sales of more than $3.5 billion for this chip this year. That is up from an earlier forecast of $2 billion, but it's still below the most bullish fantasies for what sales were going to be. And of course, AMD is still early in this expansion. You add it all together, shares off by about 4% right now.
Okay, Katie, thank you very much. It is all about the forward guidance. Let's stay with the earnings. Starbucks lowering the full-year sales outlook while maintaining confidence in its profit goals. Simone Foxman has the details. Simone, what have we got?
Yeah, Manus, we're seeing shares rally in early trading despite the fact that there was not much good news in this report. The company missing estimates for its latest quarter and lowering its full-year sales outlook. But overall, the street finding that these results were better than feared. Edward Jones writing that the street had estimates that were even below what the official consensus was. First quarter results, if you dive into the numbers here, comp sales expected to rise by 5%. The expectation had been that they would rise 6.4%. That is the most recent past quarter. Underperformance in every geographical sector, but especially China and international. This was the slowest growth in a year. Earnings per share narrowly missing. Ticket size also rising less than anticipated. And for the full year, Starbucks saying it's going to see just 4 to 6% comparable sales growth, down from as much as projections of 7%, but did. That is one of the bright spots, maintain its EPS growth guidance of 15 to 20%. Bulls, however, seeing glimmers of hope, in part because of the maintenance of that guidance. Wells Fargo also saying that full year 2024 targets are more achievable now that it's set that lower expectations. But maybe what we're seeing in the stock is simply a reaction to the fact that shares are down 13.8% this past year. So maybe seeing some room for profitability ahead, Manus.
Okay, Simone, thank you very much. On Starbucks, one breaking news headline, one stock which is in focus. I just want to bring it to your attention. It's a New York Community Bank Corp. Stock down 41%. This is one of the regional lenders. It bought deposits. Take your mind back. It bought deposits from Signature Bank. $38 billion of assets from Signature, $25 of cash, $13 billion of loans. A surprise loss for the fourth quarter, cutting the dividend. It's talking about loan loss provisions soaring, weakening credit quality, lowering the quarterly payout to shareholders. Canaries, coal mines, make of it what you will, but it's a gouging of New York Community Bank Corp. Joining me now is JP Morgan's Bob Michael, looking ahead at today's Fed's decision, and this is what he's got to say. The Fed has done a very good job of getting us to a soft landing. The moderation in inflation has given them reason to guide the market to rate cuts in the first half of 2024. And it's not just the FOMC decision. We've had the Treasury refunding size, boosting the size of its quarterly issuance on longer-term debt for the third straight time. Bob joins me now. Bob, good to see you. What is today's objective for Powell with this market? You're talking about front-loading rate cuts. Everybody else has come through here has said to me back half of the year. Why are you locking for the front half? Good morning.
Good morning, Manus. Manus, I'm going to tell you today is the best day ever for the Fed and Jay Powell to walk in and give a 30-second press conference. He should walk in, survey the room, and say, 6-month annualized rate of core personal consumption expenditures, 1.9%. 2% inflation target met. Look at unemployment. On Friday, we're going to have the 26th consecutive month of 4% or lower unemployment. Full employment, box ticked. And today, we got the employment cost index. It was up 0.9% on an annualized basis. That's 3.5%. That's the 2% inflation, 1.5% productivity gain. Box ticked there. Told you so. Take the mic, drop it, and walk off the floor. We're in a soft landing. They've done a brilliant job.
It's like you two playing in Las Vegas, isn't it? Drop the mic and walk off. Treasury yields dropped. A very short end of the curve, Bob. Look at this. 421. We are down 10 basis points. Now, part of this is to do with the quarterly refunding. Part of it is to do with the data. When you look at the quarterly refunding, what did you make of that?
I think it was pretty straightforward. I think the market is looking at the totality of everything and saying, if we're in a soft landing already and you still have rates at 5.25%, 5.5%, and full balance sheet runoff, then the risk is to the downside again. So the Fed can start cutting rates sooner than the market is anticipating. And then the Treasury didn't surprise with an enormous amount of quarterly refunding. It came in a little bit lighter. We were told that a couple days ago, and they came in true to form. The market's ready to absorb it.
Bob, if you're ready to have Powell drop the mic and have his Stardust moment, do you think they would cut by 25 basis points in March?
I don't think so, only because 2021, I think, is still very present to them, and they were a little bit slow to hike. They can't take the chance on being wrong on inflation again. So I think all things being equal, June still looks like the right date for them to have those discussions about cutting rates. But I think they have to start. They have to start telegraphing to the market that they're ready to cut rates. Because when you look back at 1995, which is the one soft landing everyone talks about, they cut rates 3 times during 1995. So they started to take pressure off the system. They can't leave rates where they are. They can't keep running down the balance sheet at the current pace. They need to start dialing those back. I don't know if it's May or June, but somewhere in there strikes me as the right time to begin.
I'll come back to the QT in just a second. I'm looking at a slightly longer chart of bonds. 417 was the mini recent peak that we have. We're down at 395. So is that backup? I call it a mini U-turn in yields rather than a backup in yields since we last spoke. So we've given some of that back. Is this the beginning of the next significant bull run in preparedness for what you've just laid out in front of me?
Manus, I have conversations every day with clients on when do I get into the bond market, where do I get into the bond market, how do I get into the bond market? And everyone wants to get in back where rates were in October or November, and they're a little bit frozen here. The one interesting bit of data is to look at the aggregate bond index. Today, it yields 4.7%. December 31, 2022, so 13 months ago, it yielded 4.7%. And at the end of 2022, we were looking into 2023, the Fed hiked rates 4 more times. As we look through 2024, we should see at least 4 rate cuts. you get a total do-over. You should be getting into the market at these levels because once the Fed starts bringing down rates are going to fall a long way from here.
Yeah, a lot of that, Bob, is, of course, fear, frozen, looking at it going, you know, I want to time it, I want to be perfect. But nobody ever gets the timing of this thing perfect. And if you're swinging around, if you're in or out late for 50 basis points, it's not the end of the world. Tell me this now. U.S. corporate bond sales, $188 billion in January. The spreads are tighter than a proverbial. Were you more of a buyer? I'm interested. Are you more of a buyer of credit relative to treasuries in this January? I mean, it was like the January sales. It was like Christmas ran on forever, wasn't it?
So we are, but let me go back to your comment that people are a bit frozen and want to buy back up. They're also incredibly comfortable in money market funds and collecting 5.5%. And it's hard to shake them out of there. So once they see the Fed beginning to bring money market rates down and cutting interest rates, that's going to have them piling into the bond market. And that's what worries me about where yields are. And I know everyone's worried about the amount of Treasury supply and corporate supply. Simply the fact that Treasury yields are completely below the Fed funds rate and corporate bond spreads are where they are tells you that supply is not an issue for the market. It's completely absorbed it. If anything, we could use a little bit more because we've got $6 trillion in money market funds, and a fair percentage of that is looking to come into the bond market.
Bob, make sure the JP Morgan Asset Management truck is at the front there to load up with those treasuries when they come. Good to see you. Setting the stage for the Fed's decision this evening. Coming up later is the morning consult poll. What does it reveal? It's bad news for President Biden.
There still is time for the public to feel the economy is getting better. There's still an outside shot for an immigration deal, but there's a lot of potholes.
The latest developments out of Washington, D.C. and what it all means for markets. That conversation on Bloomberg.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Let's get you a fresh piece of economic data. It's crossing the Bloomberg terminal. Mike McKee is with me. What have we got from Shai?
A little bit of a sour bit of data. The Chicago MNI Purchasing Managers Index falls to 46 from a revised 47.2. It was thought to rise, so this is a disappointment in that sense. It follows the Empire Index from New York and the Philadelphia Fed's Index in going down significantly. So we'll see tomorrow when we get the Purchasing Managers version that the national number, ISM manufacturing, expected to fall just a little bit, but maybe manufacturing is in more trouble than we know, Manis.
Okay, Mike, again, another piece of the jigsaw, perhaps about the economy, the real economy that's going on. Mike McKee in Washington there. So from the economy to the Hill. A Bloomberg News Morning Consult poll reveals this. President Biden trails Donald Trump across 7 critical swing states, but more than half the voters wouldn't support the GOP frontrunner if he was convicted of a crime. Amory Hordan is with me side by side. So Amory, what is the top takeaway here is obviously Biden is trailing Trump, but there's a real risk for Trump in this analysis, isn't there?
Yeah, there's vulnerability for Trump, and that comes down to the indictments against him. And you have more than half of the swing state voters saying that they are not going to vote for him if he was convicted guilty. But let's look at some of the issues that the current president is facing when you look into this poll. He's trailing Trump in these key critical battleground states where elections are won and lost. And the main issue right now is the economy still continues to be a chief concern, but we are seeing more respondents in this latest iteration of this poll that say immigration is becoming top line for them, and that's one of the key issues. So you see the margin now starting to close a little bit more between the economy and immigration. If you ask voters who are 65 and older what they care about, it's neck and neck for the economy and immigration. So people might start feeling a little bit better about the economy, but they're worried about the border. And why this is so important is because right now, Manis, in Congress, they're discussing a potential border deal. And President Donald Trump has told Republican colleagues of his in Congress, these lawmakers do not accept a deal unless it's perfect. And obviously it's not going to be perfect for the Republicans because they're dealing with a democratically controlled Senate and a Democratic president.
So, I mean, the issue is this: immigration has gone right up the agenda. And of course, we did the poll January 16th through 22nd. And this was before the famous words from the president where he says he wants to shut down the border right now. So that's trying to re-grasp the narrative. This tells me that the GOP is winning the news battlefront relative to the Democrats.
When it comes to immigration,
yes.
When it comes to also crime, when it comes to how Americans feel about who would be better in terms of two wars right now.
So they trust Trump more than that?
In Gaza and Ukraine, they still trust Trump more on some of these critical issues. But also when it comes to winning the hearts and minds of Americans when it comes to immigration.
Yes.
If you also look at some of the data in the media landscape, conservative media talks about immigration a lot more than what you'd see in some of either progressive left or mainstream media. So also that's capturing some of these issues. But it's interesting because immigration is still an issue in places like Wisconsin. That's nowhere near the southern border.
Yeah, but this is almost, I mean, it's a bit of an extrapolation here, but I spent many years stuck in the Brexit mire. This is very reminiscent of the politics of Brexit, which is about putting up borders, closing down immigration, save our jobs, save our nation, America first, Britain first, whatever else. It's a quasi-escalation in a Brexit context.
Well, also what's happening in the southern border right now is it's record numbers of flows of migrants coming in. Some days it's 10,000 or more. So it's become also a huge humanitarian crisis. When you also ask voters about who is to blame for this, that blame falls to President Biden mostly and Democrats in Congress, but also these voters understand there are geopolitical tensions at play here. They talk about famine, corruption in a lot of these countries, that they understand why migrants and why people want to flee to the United States.
And again, that plays much more then to the foreign policy of the United States of America if you want to remedy some of the immigration issues. Anne-Marie Jourdain.
Root causes.
Root causes. Up early and staying late. That's what we like. It's called Bloomberg productivity. Let's get a little bit more sector action. Abigail Doolittle is on the desk with me.
Well, Manus, with this 0.6% decline for the S&P 500, not surprisingly, more sectors are down, not by a lot, just by one, but communication services being weighed on by Alphabet, down 3%. We also have tech down more than 1%, being weighed on by AMD and others. Energy down 0.7%. To the upside, we have some of the defensive sectors like healthcare and utilities. So this is really risk off. Relative to the month of January, though, it's interesting because communication services, the top sector, up nearly 6%. Tech right behind it, up nearly 5%. To the downside, today's top sectors, real estate and utilities.
Okay, Abby, thank you so much. Abigail Doolittle coming up on the show. Market moving events of the day. There's nothing else you really need to know. It's Fed Day.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
It's a brutal day for tech, there's no doubt about it, down 1.1%, and Google is taking the heat as the ad spending number is just not on the ticket. Keep an eye on those tech stocks. We're all eyes down today for, of course, the Fed. 2 p.m. Eastern Time, followed by Chair Powell's news conference. Bob Michael, line of the day. Walk in, do it in 30 seconds, and then drop the mic. Qualcomm, those earnings hit the tape after the bell. More on the chips business. Tomorrow we turn our attention to Bailey at the Bank of England, and Amazon, Apple and Meta earnings hit the slate. Finally, Friday, you got it. Jobs report for the USA. That is Countdown to the Open. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Bloomberg Intelligence. Alex Steele is still on assignment. She's jetting back from Italy. So I hear, hopefully with the wine I requested. You think, John, she's going to come back with that wine we put in?
Well,
I wanted a nice Barolo. Is that too much to ask?
You have to go to Florence for that? You can't pick it up downstairs?
Can't pick it up downstairs. Anyway, we got Emily Grafeo from Bloomberg News sitting in for Alex Steele. Coming up, we're going to check in with George Ferguson. He's a Bloomberg Intelligence aerospace analyst. Figure out what's going on with Boeing. They just reported some earnings. And then Matt Winkler, the founder of Bloomberg News. He's going to come in. He's got a fascinating opinion piece here on Mr. Elon Musk, Tesla, profit margins. He gets into the numbers there. And then we're going to bring on Herman Chan. He covers regional banks for Bloomberg Intelligence because we got a problem there with the New York Community Bank. And is that an issue for regional banks in general here? So that's all coming up. But first, let's kick it off with a Bloomberg Business Flash. Mr. John Tucker.
All right, let me start off with that because that's an eye popper on the screen. New York Community Bank, 38% lower. Overall, tech-heavy NASDAQ selling off right now. It is down 1.2%. Tech giants, of course, weighing on the stock futures stocks as earnings failed to live up to the high expectations. After their earnings, Google shares down 6%. Microsoft recovering somewhat from the earlier sell-off in the pre-market, now down just 0.7%. Well, the decline in the NASDAQ might be worse if it weren't for lower Treasury yields. The 2-year was down 6 basis points. Part of the reason for that, Treasury increasing the quarterly debt sale, but suggesting no more boosts are coming. Meantime, as the Fed wraps up the 2-day policy meeting today, Julia Coronado at Macro Policy Perspective sees the first rate cuts, yes, in March.
I do expect them to move in March. I don't see there's a reason holding them back. We expect
as long as the January inflation data don't repeat the surge that we saw last January, if it looks more like the last 6 months, which is very benign, I think that they go ahead in March and get this process started.
And then on the data front this morning, numbers from ADP this morning showing companies adding fewer jobs than forecast at the start of the year, consistent with a gradually cooling labor market. Again, S&P 500, 32 points lower. That's down 0.7%. The Dow is up 4-5 points, we'll call. The NASDAQ 100 down 201 again, 1.2% lower. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Emily and Paul.
John Tucker, thank you so much. We appreciate that. As always, Emily Garfeo, Paul Sweeney. We're live in a Bloomberg Interactive Broker studio. We're streaming live on that YouTube thing. So head over to youtube.com and search Bloomberg Radio. Emily, thanks so much for sitting in today. Alex is still on assignment in Italy, but on our way back, so we appreciate you hanging out for the next couple of hours.
It's Fed Day, so I'm excited to be here.
It's Fed Day, which means Tom Keene and Lisa and John Farrow, they come back for Bloomberg Television Radio simulcast at 1:30 Wall Street time. Get you all fired up for that.
They're going to geek out starting at 1:30.
Geek out on the
Fed.
Fed.
Part of it.
Exactly, after the surveillance nap. So with all that's coming up for you later today. Right now, we're looking at red and green on the screen. As John was saying, the NASDAQ down 1.2%. A couple of the tech stocks underperforming here on the back of some a little bit weaker than expected news. We'll break all that down going forward. Let's check in with Norma Linda. She covers equities for Bloomberg News. She joins us here in our NYC studio. Nora, what are you looking at today?
Let's kick things off with Paramount Global. That is the biggest gainer in the S&P 500 right now. Paul, I know you like this space, but media mogul Byron Allen made yet another multi-billion-dollar takeover offer. This time it's for $14.3 billion. It was a bid to buy all of the outstanding shares of Paramount Global, offered at 28.58 cents each for voting shares of Paramount and $21.53 for non-voting shares. As we know in the past, he's made several bids, some of those ranging from EW Scripps. He wanted to get some of those TV stations. And then separately, he made a $10 billion offer for Walt Disney last year to buy all of its ABC TV networks and a few of its other subsidiaries that it has there. But BI, on the intelligence side here at Bloomberg, they said that they're skeptical of a deal happening soon, given Paramount's $15.6 billion in debt.
Yeah, he's certainly a major player in the media space, Byron Allen, but I'm just not sure what capital he has behind him here. I'm not sure what he would bring to the table here. I'm kind of the opinion. I mean, there's certainly the issue here for getting a deal done is that why we might get a deal done is because their control shareholder, Sherry Redstone, she signaled that she wants to do a deal. And that's kind of all you need. If she's ready to do a deal, now it's just a matter of the math and who's got the higher number and who's got the better capital structure. So I still think private equity is an option here coming in here for these assets. But still, stock's up nice.
Right. I mean, you mentioned it's pretty unclear as to whether or not where this money will be coming from in the event that he would pay for a takeover. So that's definitely in focus. And there's really many options that people are speculating, but that stock is jumping as much as 15% today nonetheless.
All right, good stuff for them. What else you got?
Looking at the regional bank space, I know we just spoke about this a bit ago, but New York Community Bank shares are plunging as much as 46%. That's the biggest drop that they've had on record, and they're plunging to their lowest level in almost 24 years. This is really interesting, especially with it falling after reporting a surprise loss for the fourth quarter and a cut to its dividend. The bank lowered its quarterly payout to shareholders to 5 cents. Stephens analyst Matt Brees calls this a game-changing miss.
Yeah, I mean, they purchased Signature Bank's deposits, so they actually, requires, I guess, additional capital levels. So this is really a surprise for the marketplace. We're going to speak with Herman Chan, Bloomberg Intelligence, in the 11 o'clock hour, and he's going to break it down for us. But again, this is definitely some of the concerns for these regional bank investors, which is, are some of these balance sheets at risk here?
Yeah, and the Bloomberg News article that talks about New York Community Bancorp said that a worsening credit outlook contributed to the unexpected loss. And I feel like for the last few months, everyone's been saying, oh, the credit market looks okay. Yep. This is kind of surprising. I'm interested to see if we see this move reverberate.
Yeah, and you wonder how much of this is tied to New York City commercial real estate. So again, we'll be interested to get the reporting on that. We'll talk to Herman Chan on that because again, you just look around, a lot of empty buildings here in Manhattan still.
Right. It feels like these regional banks really can't catch a break, and especially with that tied to the Signature Bank, it's really got investors a little bit in turmoil.
We also had some tech earnings last night. What are you seeing in the marketplace?
Felt like we heard from everyone.
Yes.
But a lot of these tech companies are really working hard to progress in developing AI, and it feels as though it doesn't matter what they do, investors' expectations for the technology industry is just really high, and it seems that it's really hard for some of these companies to meet the expectations. We've got Microsoft and Google, who are obviously two rivals in the software and cloud computing space. They delivered mostly good news in their reports, but it still elicited a bit of skepticism from investors. Microsoft, its revenue increased at the fastest rate since 2022. This is spurred in part by AI products helping to drive adoption of its data center services. We've got the NASDAQ slipping as AMD, Google, and Microsoft are all in focus. AMD shares are down as much as 5.5%, Google down as much as 6.9%, and Microsoft, as though it's paired some of those losses, it's down as much as 0.8%.
All right, Norma Linda, thank you so much. We appreciate that. Norma Linda, she covers the equities for Bloomberg News. We appreciate getting a few minutes of her time here. One of the other earnings news, Emily, was Boeing. They put out some good numbers for their quarter, but they pulled their guidance because there's a lot of questions as to what the regulators are going to ask them to do about some of their aircraft and some of their delivery capabilities and things like that. Pulling guidance is, to me, a big deal.
Right.
Yet
but
the stock's up 3%.
It seems like it's working for the investors. They say, oh, we're going to pull the guidance, we're going to focus on safety, and that was enough to bring the stock up 3%.
All right, so let's bring in somebody who actually does this stuff for a living. George Ferguson, he's a senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. He's been following Boeing for decades. He knows what he's talking about here. George, first, give us your takeaway from the quarter, and then second, I guess more importantly, is what's behind their decision to pull their guidance, do you think?
Yeah, so thanks for having me on, as usual. So I thought the quarter's numbers looked, pretty much in line with what we expected, maybe a little bit better commercial airplane. Some of the cash flow generation was a little bit better, a lot of it from deposits, that they're getting from airplanes as they move through production. So I wouldn't call that sort of, that's good cash flow, but I wouldn't call it super high quality, right? Like when you're generating a lot of cash from your core operations. Their global services business had some very nice margins, even better than we expected. And that's been a star performer. It's good to see that holding up. But yeah, I think the real story here is about going forward, how they nip these quality problems in the bud. And so I do think that as I think about it more, sort of pulling back guidance, I think that indicates that management is ready to do whatever it takes to get these quality problems in hand. And so, my sense is maybe they think, look, we may not want to be holden to an exact number of airplanes in 2024 as we dig through our manufacturing process and through the supply chain processes and make sure that we're getting a quality airplane out the door every single time. So if pulling guidance is all about that and the efforts around that and what it's going to take, and focusing again on quality over just management metrics, I think that could be a very, very good sign. Again, the management team is crystal focused on this is what we have to do.
How different is that than, oh, sorry, go ahead.
No, go ahead, sorry. No.
Well, I was going to say, how different is that than what the company has already been doing for the last few years? Were they not as focused on quality and safety beforehand? Like, how much of this is truly a turnaround and a change for Boeing?
So I think the business has just materially changed. I was at an aerospace defense conference last week. I didn't need the conference to tell me this, but I was surprised that it was persistent. And what I heard from people at the conference over and over again is that finding employees and employee turnover is still a problem in this industry. It's still a problem. Now, I think that the higher you up in the tiers, like a Boeing or an RTX or a GE, it's easier to retain employees because you provide great benefit packages. Everybody wants to be there. But even they have had a lot of turnover. And so I think pre-pandemic, you could potentially fall back on the thought in the manufacturing process of Boeing that you had very, very seasoned folks on the line that have been well-trained, seen years in and years out of the business, and we're always going to get it done right. But I think with the amount of turnover they've had, they really need to go back and rethink you know, how they supervise the line, how they train the employees, and they have to create more stability by investing in those people. And so I think this business has materially changed since the pandemic. I will also say that, you know, Boeing has been sort of pushing this outsourcing of the business. Again, they were doing this pre-pandemic, and this is all about, it's, you know, they want to sort of turn it into the auto industry where you outsource subcomponents, you bring it together in Renton, and you put together an airplane. And that's turned the supply chain into a much bigger, you know, portion of what you're doing. And it's global as well, right? You're making some of these doors in Malaysia. Things are coming from all over the world into Renton to turn into an airplane. And I think that's making it more difficult to keep track of the supply chain and the quality in the supply chain and what folks are doing down at those factories. And so I think it's materially changed, and that's the problem.
So, George, and that sounds like a problem to me that was probably decades in the making, i.e., you know, going more to subcontractors and you know, as part of globalization, perhaps. Is there a sense that this is really a long-term fix, that investors should not expect anything months, maybe it's going to take years here?
Well, so I mean, I don't think they're going to stop production. I do think they're going to dig through the supply chain, you know, sort of hopefully methodically and figure out where there could be sources of problem. But I think what it means is that you're just not going to see potentially the margin and the cash flow out of this business that you saw pre-pandemic for years, while they spend more money and more time and invest in people and go down and make sure that everything works. Some stuff may need to be reconsolidated back at sub-tier suppliers or even at Boeing if they can't get comfortable that they're going to get the quality out of it. I think it drags, like I said, in earnings, cash generation for
George,
years from now.
At the same time, what I hear from you and from others in the airline business is there's a big demand for new aircraft out there. So how do they balance maybe slowing down the line a little bit with the fact that their customers need more and more of their product?
So I think it hurts. I think you'd like to be breaking to higher build rates now. Airbus will get market share. But I think in the long term, if you don't fix the quality problem here, you'll lose long-term share and competitiveness, and that would be really, really bad.
What does this mean for Boeing's stock price? Because like we said, it's up today, but you compare it to Airbus, it's underperforming on a year basis by 33 percentage points, Boeing versus Airbus. So is this enough to bring investors new money into Boeing? Or is Airbus still going to be the outperformer here?
So I mean, I think, you know, Boeing investors are going to have to take the long view here, right? Because again, I don't see any quick fix, you know, quick leaping to much higher build rates, much better cash generation, because I think they need to invest back in their business. Airbus doesn't apparently have this problem. I think more of the supply chain is still in-house at Airbus, or at least better controlled. And so I think you're going to see that Airbus is going to perform fundamentally better here.
Is there a regulatory risk here for Boeing? Is there any sense that, I don't know, Washington, I'm not sure which agency would say, hey, we're going to be kind of paying a lot more attention to you guys, forcing you to slow your line down, anything like that?
I definitely, right? The FAA has already said they're going to increase their oversight of Boeing and the suppliers. You know, look, in a perfect world, you wouldn't want to have these quality problems, and you'd like to be filling out less paperwork. You could make your business more efficient. They're just not going to get that here. We could all understand the FAA's reputation's been hurt as well. So they are going to have more regulatory oversight, and that will be a drag.
All right, George, thanks so much for joining us. We appreciate that as always. George Ferguson, he covers the aerospace companies, the defense companies, the airlines companies, that whole ecosystem. That's where George's investment research focus is. And so he's our go-to person on Boeing, the other aerospace companies, and then the ultimate customers, the airlines. And then, you know, what we hear from the airlines is traffic's back. We need new planes. We need more planes. We need more efficient planes. And that's good news for the the Boeings of the world and the Airbuses of the world. But as George was suggesting, probably top of order for Boeing is to kind of get their quality issues addressed, as quickly as possible, because that's in the long-term health of the company.
Yeah, there's been a lot of focus on Boeing in the last few weeks.
Yeah, absolutely. So Boeing, I mean, just looking at this stock here again, it's up about 2.9%, $206. It is down about 21% year to date. So definitely been under pressure, and as Emily pointed out, really underperforming its competitor Airbus. But I guess if you're Boeing, you have to take the long-term view here and maybe sacrifice some near-term stock price performance in order to, kind of focus on the long term. Looking at these markets more broadly here, the S&P is off about 0.7%. The Dow pretty much unchanged on the day. The Nasdaq off about 1.3%. That's what we've seen some of the tech companies, particularly Google, underperforming a little bit on some, a little bit of concern on some of their recent numbers. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. In the run-up to the Fed decision today, Treasury yields are lower. The two-year, which I always say is more policy reactive, right now that is down a whopping 11 basis points. right now at 422. Now, part of that story is a flight to quality. Some jitters with New York Community Bank as its shares are down 35% right now. The major averages lowered to little change for stocks, and tech, of course, taking it on the chin. Tech-heavy NASDAQ down over 1%. Investors not too thrilled with earnings from Alphabet and Microsoft, as well as Advanced Micro Devices. Again, the Magnificent Seven continue with their earnings tomorrow. We're going to get, among others, Apple. Right now, the S&P 500, 35 points lower. That's down 0.75%. We're at 48.89 on the index. The Dow Jones Industrial Average is up right now, up 33 points. Up almost 0.1%, and the NASDAQ 100, 236 points lower. That is down 1.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Em and Paul.
All right, John Tucker, thank you. Appreciate it. Emily Grafeo, Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. There's somebody new every day in the seat, and I got to stay on top of it. We're also on Bloomberg. We're also on YouTube, so go to youtube.com, search Bloomberg Radio. Check us out on the video side. It is Fed Day. 2 o'clock is the announcement. We'll have a press conference at 2:30. Bloomberg Radio and TV be covering it. Tom Keene, Lisa Abramowitz, John Farrow, I believe, at 1:30 p.m. Wall Street time, so we'll have full coverage there. What are we going to get from this Fed? I don't know, but the markets are certainly pricing in a dovish 2024 in terms of rates. Let's check in with somebody who actually gets paid to do this stuff. Glenn Smith, Chief Investment Officer, GDS Wealth Management, Flower Mound, Texas. Glenn Smith, thanks for joining us here. Where's Flower Mound, Texas?
Absolutely. We're about 10 miles north of Dallas.
Nice. See, just say Greater Dallas. I mean, you know, Flower Mound is nice.
Are there flowers on the mound?
You know, there actually is a flower mound. It's very
perfect.
small. I think it's about 7 acres, but there's definitely a flower mound.
Awesome. Check it out next time down. All right, Glenn, what are we doing here with this Fed? We're going to hear from them later this afternoon. The market certainly says, hey, 2024 is going to be a year of rate cuts. How are you guys kind of pricing that in?
Absolutely. We think that the Fed is going to talk about how resilient and strong the economy is. Consumers are doing really good. We have inflation dropping, not quite at their target of 2%, but we're at 2.9. We have unemployment numbers very, very low. And I think they can be a little bit patient here. I don't think they want to lower rates before they actually need to. In the 70s, obviously, we had Arthur Burns do that. And then what happened is inflation was persistent. And I think they want to do this right the first time. And because of that, we think rate cuts won't start until June of this year. And we will have 3 rate cuts every other Fed meeting in 2024.
Glenn, how are you thinking about the market reaction to the Fed today? Because like John was saying a little bit earlier, we already have the 2-year down 11 basis points today. So what do we need to move yields even lower? And if Powell isn't ultra dovish, does that mean that we actually see yields reverse higher today?
No, I don't think so. I think the economy is very strong, and that's what's giving them a little bit of a mulligan here for rates not to go up. We think that that they have a little bit of margin for error because the economy is so strong right now. I don't anticipate rates changing until later in the year when inflation comes down a bit.
All right, so Glenn, what do we do here? I mean, Emily Grafeo, she's long those Magnificent Seven stocks. She's been laughing all the way to the bank. Other folks like Matt Winkler and me, we are not so smart, so we weren't long those stocks. What do we do here in 2024 if we've missed some of those big tech names?
I think the Magnificent Seven, if you own them and you're not overweighted them, you want to maintain them. But I don't think this is a great entry point. I think there's other sectors out there, whether it's financials, whether it's energy stocks. Specifically in financials, we really like JP Morgan right now. If rates do stay elevated, we have net interest margins that will be phenomenal for them and continue to give them earnings.